It is 3 in the morning on a Monday in September, and across the gleaming spine of Lower Manhattan, the trading floors lie in darkness. The great cathedral of capitalism has gone quiet. Glass towers rise into an indifferent sky, their windows dark except for the occasional security light bleeding through empty corridors. No one moves through these spaces now. The Bloomberg terminals sit dark and silent, their screens long since shut down for the night. The endless scroll of numbers and prices and algorithms paused in their relentless march. The coffee cups that line the desks, some still half full, some abandoned hours ago, have gone cold. This is the hush before something breaks. In the silence, you might notice the faint hum of the building itself. The servers, those vast rooms of machines buried deep below street level, continue their work even in the dead hours. They breathe, they pulse, they hold in their crystalline logic the entire apparatus of global wealth. Billions of dollars exist only as information in these machines, as electrical impulses moving at the speed of light through fiber optic cables that connect New York to London, to Tokyo to Sydney and back again. Money, in its modern form, is not what you hold in your hand. It is a story the machines tell one another, verified by the invisible trust of millions of strangers who have agreed, collectively and without quite realizing it, that the numbers on the screens mean something real. But on this particular September night in 2008, that story is about to rupture. Imagine, for a moment, what happens when a system of trust, one so vast and interconnected that it touches nearly every human life on Earth, begins to unravel. What does it feel like when the invisible assumptions that hold civilization's financial architecture together start to crack? This is the story of the night the world's money nearly died. Not literally, of course. Money itself is resilient. It cannot truly perish. But the confidence that money represents, the mutual agreement between countless strangers that their savings and pensions and life's work mean something, that confidence can evaporate in hours. It can disappear like water into sand, leaving behind only a profound silence and the realization that what seemed solid was, all along, built on something far more fragile. If you're drawn to the quiet architecture of how systems collapse, to the slow accumulation of choices that lead to sudden crisis, to the human stories buried beneath the abstractions of markets and credit and derivatives, then I invite you to subscribe to this journey through the 2008 financial crisis, the night the world's money died. This is where we explore, together, how the greatest financial panic of our time unfolded in real time, how ordinary people became caught in the machinery of forces they could not see, and how, in the aftermath, the world learned to breathe again. Now, let us return to where this story truly begins. Not in September, though that is where it culminates. Not in the dark hours of crisis, though that is where we are drawn. Let us instead step backward in time, to the early years of the 2000s, to an America bathed in a kind of suburban calm, a nation convinced of its own perpetual ascent. The years leading up to the crisis were not characterized by obvious fear or warning signs, not for most people. Instead, there was something else, a pervasive, almost languid confidence. Interest rates sat at historically low levels, banks were eager to lend, credit was cheap, abundant, almost embarrassingly easy to obtain. If you wanted to borrow money, institutions seemed almost eager to place it in your hands. The Federal Reserve, guided by a chairman named Alan Greenspan, who had cultivated a reputation as an almost mythological economic sage, had engineered what many believed was an economy freed from the constraints of the past. The American dream, that old and powerful notion that a person could, through work and determination and the purchase of a home, build a foundation for a better life. This dream was being sold, marketed, enabled. In suburbs across the country, families were signing papers for houses, ordinary people, teachers, small business owners, construction workers, people who had saved what they could, who worked their jobs faithfully, who wanted what seemed like a basic right, a place to call their own. And the financial system, with open arms and predatory intent that most could not yet see, was offering them a path. All they needed to do was borrow. Borrow, and the house would be theirs. In those towers, in those marble-floored temples of capital, something else was humming beneath the silence. The servers never truly slept. Even as the human traders had filed out through glass doors and into the cool night air, the machines continued their patient arithmetic, blinking in the darkness, processing trades that had been entered hours before, calculating positions that would come due when dawn broke again across Manhattan. The ticker tape, that old and almost obsolete thing, still existed in a digital form now, invisible, moving at the speed of electricity through fiber optic cables that webbed beneath the city streets and across the Atlantic, carrying whispered conversations between London and New York, between Frankfurt and Tokyo, all of it happening in the hours when most of the world was supposed to be still. The hum of that infrastructure was something few people ever heard. It was the sound of credit flowing, of money moving from one account to another, of prices updating in real time on screens in darkened offices and in the homes of traders who could not quite bring themselves to sleep. That hum carried within it something almost alive, the collective breath of the global financial system, a system so vast and so intricately woven that no single person could see its full shape anymore. And perhaps that was precisely the problem that would become visible only much later, only after the hum had begun to stutter and fail. But before we go any deeper into that descent, I want to invite you to come back to this particular story when you're ready to fully surrender to it. If the architecture of modern finance fascinates you, the elegant, terrible architecture of how money itself has been transformed and abstracted and layered into instruments that even seasoned professionals struggle to understand, then this is the journey we're taking together. We'll walk through the years leading to 2008 without rushing, tracing the quiet decisions that seemed reasonable at the time, the mathematical elegance that masked profound risk, the human hope and human greed that became indistinguishable from one another. So whenever you return, we'll be here, moving slowly through the night, when the world's money nearly evaporated. For now, let yourself settle deeper into what comes next, into the years before the collapse, into a time when the possibilities still seemed infinite. The early years of the 21st century had carried with them a particular kind of American confidence, a sense that certain things had been solved forever. The Cold War was ancient history now. The internet had arrived and had transformed everything, or so it seemed. And in the housing market, a deep, almost religious belief had taken hold across the country, one that extended from the poorest neighborhoods to the wealthiest suburbs, one that said, "Your home is not just shelter, it is an investment, it is the central pillar of the American dream, and its value will always, always rise." This belief was not a small thing. It structured the way families thought about their futures. It shaped the decisions of young couples in Ohio and Arizona and Florida and California. It influenced the policies of the federal government, which had long viewed homeownership not merely as a financial goal, but as a moral good, as something that should be encouraged and supported, and expanded to include more and more people, regardless of their income or their ability to service the debt they were taking on. The government-sponsored enterprises Fannie Mae and Freddie Mac had been created precisely for this purpose, to make mortgages available to people who might not otherwise have access to them, to bundle those mortgages into securities that banks could sell, freeing up capital for banks to make new loans. It was a system designed with genuine idealism at its core, and it was also a system that, by the early years of the new millennium, had begun to warp in ways that few people fully recognized. Interest rates were low. This is where the story really begins to take shape. In 2003, 2004, 2005, borrowing money was cheap. The Federal Reserve, under the leadership of Alan Greenspan, had held interest rates at historic lows in order to stimulate the economy after the brief recession that had followed the dot-com bubble. This meant that anyone who wanted to borrow money could do so at rates that seemed almost unbelievably favorable. A homeowner could walk into a bank and be offered a mortgage at a rate lower than they might have expected even a few years earlier. And if they refinanced existing mortgages, they could lock in even better terms, free up cash, pay off credit card debt, fund renovations or business ventures. The math seemed to work beautifully, as long as you didn't pause too long to ask what would happen if something changed. What would happen if rates rose? What would happen if home prices stopped climbing? What would happen if people lost their jobs? These were not questions that seemed to matter much in the moment. The American financial system, in the middle of its first decade, seemed to have found a perpetual motion machine, and Wall Street, sensing opportunity and profit in that machine, began to reach through the system to grab more and more of it, to leverage it, to multiply it, to transform it into structures so complex that even the people building them were not entirely sure how they worked. To understand how the financial world came to stand on the edge of an abyss, we must first return to a moment that felt, to nearly everyone, like a beginning rather than the prelude to an ending. The early 2000s held a particular quality of certainty, a settled confidence that things would only continue upward, that the American economy had discovered some new and permanent equilibrium where prosperity was no longer a luxury reserved for the cautious few, but rather something that could be extended, almost infinitely, to nearly anyone willing to sign a piece of paper. The technology bubble had burst just a few years earlier, in 2001, and the nation had absorbed that shock with a kind of resigned pragmatism. Yet by the early 2000s, a new source of wealth was already beginning to hum beneath the surface of American life, quieter and more diffuse than the dot-com fervor, but in many ways far more powerful because it touched something deeper in the national consciousness. It was the dream of homeownership, an aspiration so woven into the fabric of American identity that to own a home had become almost synonymous with belonging to the middle class itself. In the suburbs and exurbs spreading across the landscape, in the smaller cities and towns where the cost of living had not yet spiraled beyond reach, millions of families were beginning to think that perhaps, finally, their turn had come. After decades of watching property values climb steadily beyond their grasp, after years of being told that rents were throwing money away while home ownership was an investment in the future, they were receiving a message from every direction that the path to the American dream was finally opening to them. The reason for this sudden accessibility was deceptively simple and deeply seductive. Interest rates had fallen to levels not seen in many decades. In 2003, the Federal Reserve under Alan Greenspan had lowered its benchmark interest rate to just 1%, the lowest it had been since 1954. The reasoning, at the time, seemed sound. The September 11th attacks had shaken the economy, and the wars that followed had created uncertainty. Low rates were meant to stimulate growth, to encourage borrowing and spending, to keep the machinery of commerce humming when confidence was fragile. What emerged was not merely stimulus, but something far more dramatic. With interest rates so low, the monthly payment on a home loan became, for the first time in recent memory, almost shockingly affordable. A family that might have been able to scrape together enough for a down payment on a small house in an out-of-the-way neighborhood could now, through the magic of low rates and longer loan terms, dream of something larger. A house with a garage, a house with a yard, a house, perhaps, in a neighborhood where they had never imagined they could afford to live. The lending industry, sensing an enormous and seemingly limitless appetite, began to expand dramatically. Banks and mortgage brokers opened branches in shopping centers and strip malls. Loan officers, many of them paid on commission for each mortgage they closed, began actively recruiting potential borrowers. The process itself became streamlined and almost frictionless. Documentation requirements that had once been stringent began to loosen. Verification of income, once standard, became optional. The idea that you needed a substantial down payment, perhaps 20% of the home's purchase price, began to seem quaint and unnecessarily restrictive. Lenders developed new loan products with names that sounded almost reassuring in their ordinariness. There were adjustable rate mortgages, loans that started at incredibly low teaser rates, sometimes lower than the actual inflation rate, which would then adjust upward after a period of years. There were interest-only mortgages, where borrowers paid nothing toward the principal for the first few years, only the interest expense itself. There were loans that allowed borrowers to pay even less than the interest owed, with the unpaid balance simply being added to the principal, a mathematical impossibility that somehow seemed, in the intoxicating logic of the moment, perfectly reasonable. Who might take out these unusual loans? Anyone, it seemed, might qualify. A school teacher with a stable income of $50,000 annually could suddenly find themselves approved for a home worth $500,000 or more. A family working in the service industry with variable and uncertain income could obtain a mortgage on the same terms as someone with decades of steady employment. The assumption underlying all of this, rarely stated but everywhere implicit, was that home prices would continue to rise indefinitely. In the suburbs and small towns where homes had once been treated as places to live, they were increasingly being viewed as investments, assets that would appreciate steadily year after year. Families began to see the equity in their homes as an accessible source of funds. If your home had doubled in value, why not take out a second mortgage, a home equity line of credit, and use that money for renovations, or a new car, or to pay off other debts? The home itself seemed to be a reliable money machine, a way to transform residential space into liquid wealth. This wasn't cynicism on the part of borrowers, but rather a kind of mass collaboration in an optimistic vision that seemed to be supported by every available statistic and expert opinion. Home prices in most of America had been rising for decades. The Federal Reserve Chairman, Alan Greenspan, had achieved something approaching oracle status in the eyes of markets and policymakers alike. The economy, though it had stumbled slightly, continued to grow. Unemployment, while having risen modestly after 2001, was not severe. Corporate profits were expanding. The stock market, after its dot-com collapse, had recovered and was rising again. The prevailing wisdom, stated so frequently and by so many credible voices that it seemed to approach the status of natural law, was that the American real estate market could not fail. House prices might slow or plateau, but the idea that they might plummet, that people might owe more on their mortgages than their homes were worth, struck nearly everyone as not merely unlikely, but impossible. How could such a thing occur? Houses were tangible, necessary assets. People would always need somewhere to live. Demand could only increase as the population grew. And yet beneath this rising tide of optimism, in offices and at dinner tables, and in the hearts of a few persistent skeptics, there were questions being asked that would, in retrospect, seem almost prophetic in their clarity. Were interest rates being kept artificially low for too long? Were lending standards being compromised? Was it truly possible for homeownership to be extended endlessly to borrowers with increasingly questionable ability to repay? But these questions were whispered, when they were asked at all, in a cultural moment that had little patience for worry, little use for caution, and an almost religious faith in the idea that the rules of economics had somehow been transcended, that this time was indeed different. A mortgage, at its simplest and most essential, is really just a promise. A family walks into a bank and asks for money to buy a house, and the bank says yes, but only if you promise to pay us back. slowly, over many years, with a little extra for our trouble. That little extra is interest. The house itself becomes the collateral, the thing the bank can take away if you stop paying. For most of the 20th century, this was how mortgages worked. A local banker knew the family. He might have known their parents. He understood the neighborhood, the stability of their employment, the character of the people asking for the loan. The entire arrangement existed in a relationship of genuine consequence. The banker kept his own skin in the game, because if the borrower failed, the bank felt the pain too. But beginning in the 1970s, something began to shift in the architecture of American finance. A few visionary minds in the bowels of Wall Street started asking a simple but transformative question. What if we didn't have to keep these mortgages? What if we could sell them off to someone else? This idea, which seemed almost radical at the time, eventually became the foundation of an entirely new way of thinking about home loans. Instead of a mortgage being a relationship that endured for 30 years between a family and their local bank, it became something else entirely, a commodity, a thing that could be bought and sold like wheat or oil or steel. And once that fundamental shift happened, once bankers realized they could originate a loan and pass the risk along to someone else, the entire incentive structure of lending began to crack at its foundations. Think of it this way. Imagine you lend your friend $5,000 to buy a car. If you know that loan will be yours to carry for 5 years, you'll be careful about whether your friend can actually afford to repay you. But imagine instead that you could sell that loan to someone else within a month. You take a small fee for arranging the deal, and then it becomes their problem entirely. Suddenly, you have far less reason to be cautious. The incentive to verify your friend's ability to pay starts to fade away. This is what happened to American mortgages. Banks began originating loans more quickly, with less stringent verification of the borrower's ability to repay, because they knew they wouldn't be holding the loans for very long. They would sell them to Wall Street investment firms within weeks or even days, and those investment firms would take those mortgages, sometimes thousands of them, bundled together, and transform them into something altogether different. A mortgage-backed security, as it came to be called, was an attempt to slice up the future cash flows from all those home loans and repackage them as investment products. When a homeowner made their monthly mortgage payment, that money would flow through a series of financial channels and ultimately make its way to whoever held shares in the mortgage-backed security. In theory, this allowed people who had no interest in real estate whatsoever, pension funds in Denmark, insurance companies in Japan, conservative investors in small towns across America, to receive a steady income stream without ever having to think about the actual houses underlying those loans. The appeal was enormous. Mortgages had been considered safe, boring investments for generations. Home prices, after all, almost never fell in the post-war era. Americans had been taught to believe that a house was the safest investment anyone could make. So a financial instrument based on mortgages seemed to inherit that safety. It seemed to offer the best of both worlds. The steady income of a bond, which is what a mortgage essentially is, after all, a promise to repay over time, combined with the mathematical sophistication and professional management of a Wall Street investment product. But there was a subtle psychological shift that happened in this transformation. When a banker held a mortgage, he knew a name went with it. He knew there was a family depending on their home and a specific human risk. When an investment firm bought a mortgage-backed security made up of 10,000 mortgages, the individual names disappeared entirely. Those mortgages became statistics, abstract mathematical quantities, data points in a spreadsheet. The human dimension of lending almost entirely evaporated. And Wall Street kept pushing, kept innovating, kept trying to extract ever more value from these pools of mortgages. They started slicing the mortgage-backed securities themselves into smaller and more complex pieces. They created instruments called collateralized debt obligations, or CDOs. which took the cash flows from hundreds of mortgage-backed securities and recombined them in new ways. A CDO could be structured so that different investors bore different levels of risk. Some investors would get paid first if homeowners stopped paying their mortgages. Others would only get paid after everyone else had been taken care of. On paper, with the right mathematical models, this all seemed remarkably elegant. It seemed like Wall Street had solved the problem of risk itself. By slicing mortgages into these little pieces, distributing the risk widely across different investors and different regions, the theory went, the system had become safer than ever before. No single bank or investor could fail, because the risk was spread so thin that no single entity bore enough of it to be catastrophic. What no one adequately considered was what would happen if the underlying assumption that home prices would always rise, or at worst stay the same, turned out to be wrong. What if, for some reason, homeowners stopped being able to pay their mortgages all at once? What if the mortgages themselves were based on the assumption that borrowers would refinance before they ever actually had to repay them? What if the entire architecture of American residential finance had been built on a foundation that was, in some crucial way, just slightly off? By the early 2000s, as cheap credit flowed through the American economy and interest rates remained low, these questions seemed almost quaint. They seemed like the worried murmuring of older, more conservative minds who simply didn't understand how the modern financial system worked. The future, bankers and investors assured themselves, was going to be one of ever-rising home prices and ever-expanding prosperity. They had discovered something new under the sun, or so they believed. By the early years of the 21st century, something had shifted quietly in the American lending landscape. The rules that had governed home loans for generations, the careful underwriting, the verification of income, the expectation that a borrower would put down a substantial portion of the purchase price, began to dissolve like morning fog, and in their place emerged something called subprime lending. The word itself carries no judgment, no moral weight. It is simply a financial term describing loans made to borrowers with weaker credit histories, lower incomes, or less stable employment records than those considered prime. But the consequences of its rise would reshape the world. Picture, if you will, a modest neighborhood somewhere in America. It could be Florida, or Nevada, or California, or Ohio. The houses sit quietly in the afternoon light, their lawns edged with care. Inside one of these homes, a family sits around a kitchen table. Perhaps they have been renting for years. Perhaps they have always worked steadily, but never quite managed to save enough for what was once the traditional down payment, 20%, a mountain of savings. Their credit score is not excellent. A missed payment here, a medical bill sent to collections there. Nothing catastrophic, simply the small financial stumbles that ordinary people encounter. And yet, by the early thousands, they could suddenly hear words they had never heard before. You can get a home. We can make this work for you. The barrier that once seemed permanent had developed a door. Subprime lenders, companies both small and large, some legitimate institutions and some operating in murkier territory, began to market aggressively. They appeared on television. They set up offices in strip malls. They called people whose credit reports had been flagged with lower scores. And they offered something that felt like liberation. The ability to own rather than rent, the chance to build equity, the promise of joining a class of people that American culture had long celebrated. Homeowners. What could be more reasonable, more wholesome? The mechanics of these loans were, at first glance, simple enough, but they contained within them the seeds of the crisis to come. Many subprime mortgages were structured with what became known as adjustable rates. In the early years, the first 2 or 3 years, the interest rate remained artificially low. Teaser rates, they were sometimes called. The monthly payment would be modest enough that someone making $40,000 a year might actually afford it, might picture themselves mowing their own lawn, painting their own walls, receiving a tax deduction for mortgage interest. And then, after that initial period, the rate would reset. It would climb, sometimes sharply. The payment that had been manageable could suddenly leap by several $100s a month or more. But this seemed, in the moment, like a distant concern, a future problem for a future time. These loans came in bewildering variety. There were interest-only loans, where the borrower paid only the interest charges for years, building no equity at all. There were loans with balloon payments, where a small amount was paid each month, and then, at the end of the loan term, a massive lump sum would come due. There were stated income loans, loans where a borrower could simply state their income without verification. State it and move forward. How many of these were inflated, exaggerated, or entirely fabricated? Perhaps we will never know exactly, but lenders seemed not to ask too many questions. Because the loans themselves were not intended to be held. They were not intended to be watched over for 30 years by the same institution that originated them. They were designed to be sold, quickly, immediately, if possible, bundled, transformed, moved somewhere else. And so lending standards, in a very real sense, began to evaporate. If a loan officer knew that the loan would be sold within weeks to someone else, to an investment bank, to a financial institution hundreds of miles away, where was the incentive to ensure the borrower could actually repay it? The risk was no longer theirs. The responsibility had been transferred elsewhere. Picture again that family at the kitchen table. They are speaking with a loan officer, a person whose salary and bonus depend on how many loans they originate. How many can they close before the month ends? The loan officer might be a good person, honest by nature, or the loan officer might be operating in a system that actively rewarded recklessness. Either way, the outcome was the same. The paperwork moved forward. The rate of subprime lending accelerated through the middle years of the first decade. In 2003, subprime mortgages accounted for roughly 8% of all new home loans. By 2005, that had swollen to 20%. In some regions, the share was far higher. In Nevada and Arizona and parts of Florida, subprime lending was not a niche product. It was mainstream. It was normal. A construction worker who had been with his company for 18 months could get a $500,000 mortgage. A woman working part-time at a retail store could borrow $300,000. Were these unusual cases, or were they becoming standard? The line blurred. What drove this expansion was not primarily greed, though greed certainly existed. It was something more systemic. There was money to be made, tremendous amounts of money, and there were investors around the world, pension funds in Japan, insurance companies in Germany, wealthy individuals in the Middle East, all searching for returns higher than what traditional bonds offered. They were hungry for yield, and Wall Street, sensing this appetite, would soon devise ways to feed it. But first, people had to borrow. Families had to sign. And in those quiet moments, in living rooms and office buildings, at kitchen tables and in strip mall offices, the machinery began to turn. Consider the perspective of someone in 2005, in the middle of this lending expansion. The economy seemed stable. Employment was relatively strong. Real estate prices had been climbing for years. The assumption was not stated explicitly, but it hovered beneath every transaction. Housing prices would continue to rise. They had always risen. They would always rise. If a borrower found themselves unable to make the higher payment after the adjustable rate reset, well, they could simply refinance. They could pull out the equity that had accumulated in their home. Or, failing that, they could sell the house for more than they had paid for it. This was the logic that made the system seem to work. This was the quiet certainty that pushed people forward into commitments they did not fully understand. And yet, somewhere in the data, in the subtle patterns that economists study, there were already signs. Home prices had climbed far beyond what wages would support. The typical house in many American markets was now worth 5 or 6 or even 7 times the median household income. In earlier eras, it had been 3 or 4 times. Could this continue indefinitely? Was there really no limit to how high the prices could go? These questions were asked by some analysts, some economists, some thoughtful observers, but they were asked quietly. In a market climate that felt optimistic, that felt certain, that felt like money could only flow in one direction, upward, the skeptics seemed like they were failing to see the obvious. They were missing the new paradigm. They were locked in old ways of thinking. And so the lending continued. The papers were signed. The keys changed hands. Families moved into homes they had never imagined they could own. And in the silence of those houses, in the ordinary moments of ordinary lives, nobody knew that they were standing at the edge of a financial abyss. They knew only that they had a chance. They knew only hope. Now imagine, for a moment, what happens when a banker takes one of those mortgages, a single promise to repay, signed by a family in a suburb somewhere, and instead of holding it quietly in a vault, decides to bundle it with hundreds of others, thousands even. Picture this bundling not as a simple filing away, but as something closer to the slow layering of sediment in an ancient riverbed. Each mortgage becomes one thin sheet of sand and clay, and when pressed together with thousands of its neighbors over time, the weight and density of the pile transforms it into something entirely different, something harder, something that can be sliced and sold and traded as though it were a solid, knowable stone. This bundling, bankers called it securitization, a word that sounds almost musical if you say it slowly enough, meant that the original mortgage holder, the bank that had lent the money to that family in their home, no longer bore the risk of whether the family would pay. The bank could immediately turn around and sell that bundled package to investors, pension funds in Canada, insurance companies in Germany, universities' endowments in Massachusetts. Suddenly, thousands of miles away from a modest suburban street, people who had never met the homeowner were claiming a stake in their monthly payment. The money flowed backward and forward like a great braided river, each strand representing a separate bet on whether families thousands of miles away would continue, month after month, year after year, to pay their mortgages on time. Wall Street's architects, and they did see themselves as architects, not merely as financiers, realized they could take these rivers and split them further. Within each bundled package of mortgages, not all portions of the money were equal. Some investors wanted absolute certainty. They wanted their share of payments first, like the strongest stones at the base of a structure. Other investors were willing to accept more risk in exchange for higher returns. So the banks sliced each bundle into tiers, almost like geological strata, where the safest tier at the bottom would be paid first and most reliably, and the riskiest tier at the very top would be paid last, if at all. The safest tiers looked so secure that the rating agencies, those grey, anonymous offices we'll turn to more closely in a moment, stamped them with the highest ratings, the equivalent of calling them bedrock. The riskiest tiers, sitting at the apex, they labelled as speculative, as uncertain, as the thin soil that could wash away in the first heavy rain. But here is where the architecture began to grow strange, and where the analogies of sediment and rivers start to strain a bit, because these bankers, still thinking, as bankers often do, that they had discovered something perpetually profitable, took those risky upper tiers, the portions that no traditional investor wanted, and bundled them together as well. They took the highest risk slices from 500 different mortgage pools and pressed them together into a new bundle, and then they sliced that second-order bundle into tiers again. These new creations, layered and complex, were given names that sounded almost academic: collateralized debt obligations, or CDOs. A CDO, in essence, was a financial instrument whose value depended entirely on the health of thousands of mortgages held by people whose names would never appear anywhere in the transaction. The connection between cause and effect grew so attenuated, so stretched, that investors holding these instruments could have been forgiven for believing they were as safe as holding a piece of government debt. The mathematics of it all was soothing, in its way. Computer models predicted that even if housing prices fell slightly, even if unemployment rose modestly, the mortgages would keep paying. The models showed that default rates would remain low, around 2 or 3% in normal times, and as long as some mortgages kept paying, money would flow down through the layers like water through sediment, and each investor would receive their agreed-upon portion. What the models could not imagine, or chose not to imagine, was a scenario where default rates would quintuple, where mortgages would default in clusters rather than individually, where the idea of buying a house with the expectation that it would always rise in value would prove to be, in the end, merely an idea. Some of the most sophisticated versions of these instruments, and here the structures became almost impossibly intricate, involved even deeper layers of slicing and dicing. There were CDOs made from the riskiest pieces of other CDOs. Investment banks invented names for them: CDO squared, some traders called them, synthetic CDOs, which didn't even own the underlying mortgages directly, but rather bet on whether a pool of mortgages would perform. These instruments grew so far removed from any actual family making a payment on an actual house that they began to resemble not sediment at all, but rather a kind of financial mirage, a structure whose entire value depended on everyone, everywhere, continuing to believe in its worth. By the mid-2000s, the systems that had once seemed so clever, so elegantly designed to distribute risk fairly, had instead become mechanisms for concentrating risk in places where no one could quite see it. A pension fund manager in Tokyo might own, without knowing it, a stake in a CDO that held mortgages from Florida, Arizona, and California. An insurance company in London might be on the hook for losses if homeowners in Nevada stopped paying. The connections multiplied and tangled until the financial world began to resemble not a river, which flows in one direction, but rather a vast delta where every channel connects to every other, where water flows in all directions at once, and where the presence of water upstream becomes immediately felt everywhere downstream. No one could trace the path of their money backward with certainty, and that opacity, that soft, unexamined darkness at the heart of the system, would soon prove to be catastrophic. Now, in the quietness of all this complexity, there existed an institution whose job was remarkably simple on the surface, deceptively so. The credit rating agencies, primarily 3 of them, Moody's, Standard & Poor's, and Fitch, held a peculiar kind of power. They were the gatekeepers of reassurance. They were the voices that said yes, this is safe, or no, this is risky. And in a world drowning in the opacity of mortgage-backed securities and collateralized debt obligations, their letters and their symbols became like a lighthouse in fog. Think of it this way. When you or I want to understand whether something is trustworthy, we look for signals. We ask trusted people. We do research. We hesitate. But when you are a pension fund manager, responsible for billions of dollars that belong to teachers and firefighters and nurses, you cannot personally examine thousands of mortgages. You do not have the time. You need someone else to have done that work for you. You need someone to tell you, in a clear, certified way, that this pile of risk is actually quite safe. That is what these agencies promised to do. They promised to be the expert, the independent judge, the one who looked beneath the surface so others did not have to. And there was something almost medieval about their power, was there not? They assigned ratings like grades. AAA meant highest quality, safest possible. AA meant very safe. A meant upper medium grade. BBB meant medium grade. Below that, you entered the territory of junk bonds, speculative territory, risky ground. These ratings were not opinions whispered privately. They were published. They were official. They shaped global money flows. A single letter difference, the shift from AA to A, could mean the difference between trillions of dollars flowing into an investment or those same trillions flowing away. The rating agencies themselves were profitable, important firms, staffed by people who understood finance, or at least who understood the language of finance. They had been around for decades. Moody's traced its lineage back to the early 1900s. These were not fly-by-night operators. They were institutions with reputations, with history, with gravitas. When they spoke, markets listened. When they issued a rating, investors trusted it. But there was a crack in the foundation of this system, a fissure so fundamental that few seemed to notice it, or perhaps they noticed and found it easier not to think about it. The rating agencies did not do the research for free. They were paid by the very banks and investment firms that created the securities they were rating. Let that settle for a moment. The banks would create a complex financial product. They would then pay the rating agency to examine it and assign it a grade. And if the rating agency assigned it a poor grade, what happened? Well, the bank could simply take their business to a different rating agency, one that might be more generous in their assessment. This system came to be called, with a kind of bitter accuracy, ratings shopping. It was not quite bribery, but it operated in the same psychological space. The incentives were perfectly misaligned. The rating agencies made their money when they said yes. They lost money when they said no. And the banks, understanding this perfectly well, would shop their securities to multiple agencies until they found one willing to give them a high rating. The highest bidder for the rating agency's reassurance, in a sense, was not the public seeking safety. It was the banks seeking legitimacy. In the early 2000s, this system went into overdrive. As mortgage-backed securities proliferated, as they became more complex, as they were sliced into ever more layers of abstraction, the rating agencies were flooded with requests. They had to rate thousands of new instruments. Some reports suggest that the volume of work increased so rapidly that the agencies struggled to keep up. Analysts, it has been said, sometimes relied on models that had not been updated in years. They made assumptions about housing prices that had never been questioned, because housing prices had never fallen, at least not in any meaningful way, at least not nationwide and all at once. And there was something almost calming about the models, was there not? There was something reassuring about the idea that everything could be quantified, that risk could be assigned a number, that the future could be predicted with mathematical precision. The rating agencies had their formulas. They had their historical data. They had their confidence intervals. They could point to decades of mortgage history and say, look, defaults have never been higher than this percentage. Look, home prices have always eventually recovered. Look at the pattern, the beautiful mathematical pattern. But patterns, of course, can break, especially when the world beneath them changes in ways that the pattern makers never anticipated. So by the mid-2000s, there existed this vast structure of financial instruments. At the bottom were the mortgages themselves, the loans that families had taken out to buy homes. Above that layer were the mortgage-backed securities, the bonds created from bundles of those mortgages. Above that were the collateralized debt obligations, the complex rearrangements of those bonds into supposedly safer and riskier tranches. And above all of that, like a cathedral ceiling painted with the reassuring words of 3 rating agencies, was the assumption of safety. There was a letter grade. There was an official assessment. There was permission to believe that this tower of abstractions was sturdy enough to support trillions of dollars. The rating agencies issued their certifications quietly, matter-of-factly. Their letters were not dramatic pronouncements. They were boring technical documents, stamped with logos and full of explanations of methodology. No one read them carefully except those whose job it was to read them, and many of those people did not read them carefully either. The ratings circulated through the financial world like currency, like proof, like permission. A bank in Frankfurt could look at a bond rated AAA by Moody's and think, well, Moody's has examined this carefully. Moody's is responsible. Moody's would not assign this rating unless it were true. Moody's has a reputation to protect. And this thought, this assumption of competence and integrity, spread. It moved through pension funds, through insurance companies, through sovereign wealth funds, through the investment portfolios of small regional banks that had no teams of analysts and no way to do their own independent assessments. The rating mattered. The letter mattered. The signal mattered more than the substance. And in time, people began to forget that there was supposed to be a substance at all. In the hushed investment offices and the glass towers of Manhattan, in the dealing rooms of London and Frankfurt and Tokyo, the ratings provided a kind of psychological permission. They said, you may rest easy. You may put your client's money into this. You may sleep at night. These instruments have been examined by experts. They have been certified as safe. What no one was quite acknowledging, at least not in any voice loud enough to matter, was a very simple and very troubling question. What if the experts, for all their equations and their models and their historical data, had missed something fundamental? What if the pattern they had identified was not a true pattern at all, but merely a fortunate accident of timing? What if they had built a cathedral of mathematics on sand? In those middle years of the 2000s, something remarkable and almost invisible had taken hold of the financial world. It was not yet the arrogance of collapse, but rather the quiet, pervasive confidence of a system that had begun to believe in its own infallibility. Manhattan's glass towers, those soaring monuments of steel and light, had become temples of a peculiar kind of certainty. The trading floors hummed with an energy that felt, to those inside them, like the pulse of something eternal and unshakable. And perhaps most tellingly, no one at the highest levels seemed to expect that the hum might ever stop. The bonuses told a story all their own. By 2005 and 2006, senior traders and mortgage originators were receiving payments that would have seemed fantastical just a decade earlier. These were not modest rewards for competent work, but rather sums that transformed lives entirely. A managing director at a major bank might receive a base salary of $500,000, and then, at year's end, a bonus that could equal or exceed that base amount by several multiples. For those who had packaged particularly profitable mortgages, or who had engineered the most complex financial instruments, the bonuses could reach into the millions. One trader might take home 5 million, 10 million, sometimes more, and every year the bar seemed to rise a little higher. What made this remarkable was not simply the magnitude of these sums, but what they seemed to signal. If the market was rewarding these men and women so lavishly, was that not itself a kind of validation? Did such compensation not suggest that they possessed a skill, almost a supernatural ability to navigate complexity and extract profit from chaos? The bonuses were not paid out of sentiment or generosity. They were, in theory, the market's own way of saying, you have created value, you have earned this. This logic, repeated year after year, began to calcify into something almost unquestionable. The culture that grew around these towers was one of remarkable insularity. The senior partners and traders existed in a world somewhat removed from ordinary economic life. Their children attended elite private schools. Their apartments overlooked Central Park or occupied penthouses in buildings few of their peers could even enter. They dined at restaurants where a dinner for two might cost the monthly rent of an ordinary apartment. And in this milieu, a kind of collective psychology took shape. The people at the top of finance had, through exceptional intelligence, exceptional education, and exceptional effort, risen to the pinnacle of the world's most important system. They worked with numbers and abstractions so sophisticated that ordinary people could scarcely comprehend them. The rating agencies, the derivatives traders, the engineers of securitization, these were, in many ways, the priests of a new secular religion, and they were confident in their theology. There was, too, a particular flavor to the risk that was being taken. When someone packages a mortgage into a security, when someone transforms an ordinary home loan into a slice of a complex instrument, they are doing something that feels, to the person doing it, remarkably clean and abstract. The actual human beings who took out those mortgages, the families in suburbs across America, the first-time homebuyers, the people stretching their finances to the limit, these remain distant and abstract to the people trading in their debt. Did the trader in Manhattan ever meet the homeowner in Ohio? Did they shake hands? Did they hear the anxiety in the homeowner's voice as they signed papers they did not entirely understand? Almost never. The distance, both geographical and psychological, was enormous, and perhaps that distance made it easier to believe that the entire system was sound and self-correcting. What was the implicit assumption beneath all of this? It was, fundamentally, a belief that markets could not fail in any catastrophic way. Markets might have corrections, markets might go sideways for a time, but a true collapse, a systemic failure that would wipe out trillions of dollars of value across the globe, well, that simply could not happen. The Federal Reserve, now led by Alan Greenspan, a man of almost secular sainthood in financial circles, had demonstrated repeatedly his ability to stabilize markets during crises. The technology that had enabled the creation of these new financial instruments was itself seen as a kind of safeguard. If you could slice risk so finely, if you could distribute it across so many different holders, if you could price it mathematically, then you had neutralized it. You had transformed danger into something manageable. You had, in effect, conquered the oldest problem in finance, the unknowability of the future. And there was something seductive, too, in the sheer complexity of it all. The more intricate and difficult to understand a financial instrument was, the more convinced people became that it must be sophisticated and wise. If a mortgage-backed security made intuitive sense, well, perhaps that meant it was not complex enough. The experts, after all, had engineered these things. Their PhDs hung on office walls. Their mathematical models glowed on screens late into the night. Surely, if there had been danger, someone among all these brilliant people would have seen it. Surely the danger had been calculated and accounted for. The culture of Wall Street in the middle of the 2000s was saturated with a kind of confident momentum. The market had been rising steadily, the money had been flowing, the year-end bonuses had been growing, the towers of Manhattan seemed to gleam a little brighter each year. And if you were inside that system, if you were one of the people participating in it, it felt not like hubris, but like simple realism. The market had spoken. The system had proven itself. And what was hubris, after all, but seeing danger where none existed? The architecture of this grand illusion, however, had already begun to show its first hairline fractures, though few were listening closely enough to hear the sound. It was 2006 when the national conversation about American homeownership started to shift, almost imperceptibly at first, the way a room's temperature changes when you're not paying attention. Home prices, which had climbed with such steady confidence for so many years, began to hesitate. In some markets, particularly in Florida, California, and Arizona, those sun-soaked promised lands where families had rushed to build their futures, the upward march simply stopped. The price increases that had become as reliable as sunrise began to flatten, and then, quietly, they began to fall. It was a peculiar moment in time. The machines that had been counting profits still hummed. The trading floors were still bright with activity. The bonuses were still being written. Yet something fundamental had shifted in the machinery of desire and leverage that held everything aloft. Those families who had signed papers in 2004 and 2005, who had locked in adjustable rate mortgages with initial low teaser rates, now faced a gentle truth. Their rates were adjusting upward. Monthly payments that had seemed manageable began to feel like anchors, and simultaneously, the houses they'd bought were worth less than they had paid for them. How does one reconcile such a mathematics? How does a family continue to make payments on a mortgage larger than their home's actual value? The defaults began. At first, just whispers in the data, a few percentage points here and there. In 2006, the delinquency rates, the number of homeowners falling behind on their monthly obligations, started to creep upward across the nation. It was not a sudden catastrophic wave. It was more like watching tide pools drain slowly, incrementally, a receding that no single observer would find alarming on any given day, but which accumulated into something undeniable. By 2007, analysts could no longer avoid the pattern. The subprime loans, those mortgages given to borrowers with shakier credit histories, were defaulting at rates that had not been anticipated. The algorithms that had promised such precise measurement of risk had somehow miscalculated, or perhaps they had not been asked the right questions at all. Among the financial institutions and the think tanks, an uneasy murmur began to spread, the kind of quiet conversation that happens when someone notices the ship's course has changed without permission. Analysts at major banks started publishing reports with cautious language, hedged with qualifications and conditional statements. They noted that home price appreciation could not continue indefinitely. They observed that credit was perhaps tightening. They wondered, in the polite vocabulary of financial research, whether some of the more aggressive lending practices might be creating vulnerabilities. The word correction began to appear in sentences about the housing market. A correction, as if the market were simply adjusting itself back to equilibrium, as if the invisible hand would gently restore balance. But corrections have a way of feeling less gentle when you are standing in them. In 2006 and into 2007, mortgage originators, those companies that had been born and multiplied in the low-interest years, whose business model depended entirely on the perpetual availability of cheap credit, began to fail. Smaller lenders that had rushed to capture market share by offering the most aggressive terms, the most flexibility, the most access to credit, suddenly discovered that their foundation had been built on borrowed time. By the middle of 2007, dozens of mortgage companies had closed their doors. The sound was quiet, almost administrative. There were layoffs. There were press releases. There was a peculiar absence of alarm, as if everyone understood that this was a contained phenomenon, limited to the riskiest corners of the market. Yet even as these first failures occurred, even as the earliest layers of the financial structure began to crack, the fundamental architecture remained apparently intact. The mortgage-backed securities that had been created from all these questionable loans still traded hands. The collateralized debt obligations still carried their AAA ratings. The banks that held them still paid dividends. The world's financial system still functioned. And so there was room for denial, for the belief that perhaps this was indeed a mere correction, a temporary adjustment, something that could be managed and contained within acceptable margins. The unease, though, was growing. It moved through the financial system like a slight chill, felt more than heard. In offices overlooking the trading floors, in the email chains of risk managers, in the conversations held behind closed conference room doors, there was a dawning recognition that the numbers they had been working with might not have meant what they thought they meant. The default rates on subprime mortgages were not behaving like the historical patterns suggested they should. The housing market was not recovering as expected, and most troublingly, as these loans began to fail in larger numbers, the true value of all those securities became increasingly difficult to determine. How much were they really worth? No one seemed to know. And in the world of financial instruments, when the value of something becomes impossible to establish with certainty, confidence begins to evaporate like morning dew. By early 2007, the murmurs had become more urgent conversations. Rating agencies, those institutions that had stamped their approvals so liberally on these exotic securities, began to lower ratings on mortgage-backed securities. It was not a sudden wholesale revision, but a slow process of acknowledgement that the risks they had previously assessed so casually were proving to be far more significant than their models had suggested. The sense grew that something fundamental had been misunderstood, or perhaps more accurately, had been understood perfectly well by some, but deliberately obscured from others. The first to see clearly what was coming were often the earliest to suffer, the smaller players, the institutions whose business models had relied most completely on the endless flow of cheap credit and rising home prices. And so as 2007 began its turn, the financial world stood at a threshold, though most still believed themselves to be on solid ground. The first cracks were visible to those who looked closely, but the great towers still stood. The lights still burned brightly in the skyscraper windows. The machines still calculated. The confidence, though, was beginning to erode, as slowly and as inevitably as water wears away stone. The first domino had not yet fallen, though all around the world of finance, hands were trembling. Through the winter months and into the early days of spring 2008, something was shifting in the atmosphere that traders and analysts could feel, but not quite name. Bear Stearns, one of the oldest investment banks in America, a firm that had survived the Great Depression and every crisis since, was beginning to crack beneath a weight that no one had quite prepared for. Bear Stearns had always occupied a peculiar space in the landscape of American finance. It was smaller than its rivals, Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, yet it had cultivated a certain scrappy resilience, a reputation for taking risks that others would not. And in those years leading up to 2008, those risks had multiplied and compounded in ways both visible and hidden. The firm held enormous positions in mortgage-backed securities and collateralized debt obligations, many of them now rotting quietly on the balance sheet. Billions upon billions of dollars in assets that no one truly wanted to buy anymore. By early March, the first visible cracks began to show. The firm's two large hedge funds, both heavily invested in mortgage-related securities, had begun to fail. Investors withdrew their money. The redemption requests piled up like snow, and once the redemptions began, once the withdrawals started flowing, there was a kind of gravity to it, a relentless pull downward. By mid-March, the hedge funds had collapsed entirely. The losses were staggering. Some estimates placed them in the hundreds of millions of dollars. And somewhere in the back of the minds of major market participants, a darker question was beginning to form. If Bear Stearns' own hedge funds could fail this completely, what did that say about the firm itself? What followed was a slow drain, a trickle at first, then a widening stream. Counterparties, other financial institutions that did business with Bear Stearns, that lent to them, that traded with them, began to get nervous. Credit is a peculiar thing in that it requires not just assets on a balance sheet, but faith, belief, a shared understanding that tomorrow will look like today. Once that faith begins to crack, once doubts start to surface, the drain becomes unstoppable. Major clients moved their cash deposits elsewhere. Hedge funds and pension funds began pulling their money out. The firm was burning through its liquidity, that precious store of cash that keeps any financial institution alive. By Thursday, March 13th, the situation had become critical. Bear Stearns was bleeding out. And here is where the story takes on a peculiar quality, almost cinematic in its tension. The Federal Reserve, led by Chairman Ben Bernanke, a man who had spent his academic career studying the Great Depression, understood what was unfolding. They understood that a chaotic bankruptcy of an institution as large and interconnected as Bear Stearns could send shockwaves through the entire financial system. Lehman Brothers was watching. So was Washington Mutual. So was every major bank in the world. The dominoes were standing in a very particular arrangement. On that Thursday afternoon, with the markets closing and darkness falling over Manhattan, the Fed made the first of what would be dramatic interventions. They created something called the Primary Dealer Credit Facility, a new lending window that allowed investment banks to borrow directly from the Federal Reserve. Historically, the Fed had lent to commercial banks through discount windows. Investment banks had always operated in the private market, borrowing from each other, from institutions, from wherever they could. Now the government was stepping in, extending a hand to Bear Stearns. It was a sign of just how dire the situation had become. That Thursday night, the phones began to ring. Not the ordinary phone calls of business, but urgent calls between the most powerful figures in American finance. Federal Reserve officials, Treasury officials, the leadership of J.P. Morgan Chase. They were racing against time. The clock was running out. Bear Stearns had perhaps a day or two of cash left. What would happen if the firm simply collapsed in a disorderly way? What if counterparties could not retrieve their money? What if the firm defaulted on its obligations to other financial institutions? The domino theory was not a theory anymore. It was a scenario that seemed increasingly likely. So the Fed and Treasury began to negotiate. J.P. Morgan Chase was the chosen partner. Jamie Dimon, the CEO of J.P. Morgan, was called in. The idea was simple, though its execution would prove extraordinarily complex. Could J.P. Morgan acquire Bear Stearns? Could they take it on as a subsidiary? Could they, in essence, absorb the problem before it exploded outward? But the issue was that no one, not J.P. Morgan, not the Treasury, not anyone, actually wanted to buy Bear Stearns. The firm was toxic. Its balance sheet was loaded with assets that were rapidly losing value. Who would pay full price for a company that was essentially a burden? That weekend, Friday night, Saturday, and into Sunday, became one of the most tense in modern financial history. The negotiations were extraordinarily delicate. The Fed and Treasury could not simply take over Bear Stearns. That would be a signal that the government was nationalizing banks, something that would terrify markets globally. They had to construct a story that made economic sense, or at least the appearance of economic sense. They decided that J.P. Morgan would acquire Bear Stearns, but only with extraordinary government support. The Fed would provide liquidity. The Fed would take on some of the riskier assets. The Treasury would sweeten the deal. What is the exact cost of financial stability? No one quite knew, but they were about to find out. The negotiations stretched through the weekend in quiet rooms high above the city. There were no dramatic shouting matches, at least none that reached the press. There was instead the intense focus of people trying to solve an impossible equation in real time. What price should Bear Stearns shareholders receive? If the price was too high, it would be unfair to taxpayers. If the price was too low, it would damage faith in the entire financial system. After all, what investor would ever trust a bank again if the government could simply seize it and hand it off to a competitor for pennies on the dollar? Yet if they paid too much, they would be rewarding failure, encouraging moral hazard. By late Sunday, an agreement was struck. J.P. Morgan would acquire Bear Stearns for $2 per share. $2. The stock had been trading above $100 just months earlier. It was a crushing blow to shareholders, an almost complete erasure of their investment. Some would spend years in litigation trying to recover something, but the deal was done. The Fed would provide liquidity. The deal would be announced at the opening of markets Monday morning, March 17th. There is something eerie about the hours just before such an announcement. The world does not yet know what has happened. The world is still operating under the assumption that things are normal. But in the back offices of financial institutions, in the Federal Reserve headquarters, in the Treasury Department, people know. They know that Monday morning will bring news that will shake confidence in ways that are difficult to predict. The very fact that the oldest investment banks in America could fall so suddenly, could be swept away so completely, raises a question that no one can quite answer. Who else is vulnerable? What other institutions are carrying similar burdens? What other pieces of the system might come loose? Through that long Saturday and Sunday, the markets were closed. There was a peculiar silence. The tickers were still. The traders had gone home. And in that silence, something shifted in the collective consciousness of the financial world. The assumption that large institutions were too big to fail was being tested in real time. Bear Stearns was not, in fact, too big to fail. It was being allowed to fail, in a controlled way. But what about the next institution, and the next one after that? How many failures could the system absorb before it ceased to function entirely? The weekend passed. The sun rose on Monday morning. The markets were about to open. The news would soon hit the wires. And though most of America would wake up that Monday morning unaware of what had happened, something fundamental had shifted. The crisis was no longer theoretical. It was real. It was visible. It was happening. And no one, not even the most powerful people in finance and government, knew exactly where it would end. In the months after Bear Stearns dissolved into the machinery of J.P. Morgan Chase, a deeper anxiety began to settle across the financial world, like fog rolling across a darkened harbor. The spring had passed. Summer arrived with its heat and bright mornings, and yet something had shifted in the quiet of the trading floors. Those who had survived the first shock of March were now watching the horizon with the exhausted vigilance of sailors who know another storm is forming, though they cannot yet measure its scale. The fear, when it came, did not announce itself loudly. It arrived instead as a whisper in credit markets, a slow erosion of confidence in institutions that had stood for nearly a century. Two names began to occupy the anxious conversations of government officials, investors, and analysts working through the summer nights: Fannie Mae and Freddie Mac. These were not small entities operating in distant corners of the financial system. They were, in a very real sense, the foundation upon which the entire American housing market had been built. Together, they guaranteed or owned more than half of all mortgages in the United States, a stunning concentration of risk that few had truly reckoned with until the ground beneath it began to soften. Fannie Mae, formerly the Federal National Mortgage Association, had been created during the Great Depression as an instrument of hope. The government had wanted American families to own homes, to build equity, to invest in their futures and their communities. Freddie Mac, the Federal Home Loan Mortgage Corporation, had followed decades later with a similar mandate. Both were government-sponsored enterprises, or GSEs, a peculiar arrangement in which private shareholders owned the companies, yet the public understood, with a quiet certainty, that the government would never allow them to fail. This implicit guarantee, this whispered reassurance that had existed for so long it seemed almost constitutional, had allowed them to borrow money at interest rates only slightly higher than those available to the government itself. It was an enormous advantage. It was also, as it turned out, a colossal vulnerability. By mid-2008, both companies had purchased or guaranteed mortgages that included an alarming number of subprime loans, the very loans that were now defaulting in accelerating waves across the American landscape. As homeowners walked away from properties worth less than their mortgages, as neighborhoods filled with empty houses and falling prices, Fannie Mae and Freddie Mac found themselves holding hundreds of billions of dollars in losses that they did not have the capital to absorb. The companies that had once seemed as solid as government bonds themselves were, in fact, insolvent. They were still breathing, technically operational, but they were mortally wounded, and the infection was spreading. The government watched this unfolding with a kind of grim recognition. Henry Paulson, the Treasury Secretary, was a former Wall Street banker who had navigated the financial system for decades, and he understood the mathematics of catastrophe with an almost meditative clarity. If Fannie Mae and Freddie Mac failed, the consequences would ripple outward in ways that were almost incomprehensible. New mortgages would become unavailable or prohibitively expensive. The housing market, already wounded, would collapse entirely. Investors around the world who held Fannie and Freddie securities would suffer devastating losses. The implicit government guarantee would be revealed as illusory, and confidence in American financial stability would evaporate like water under intense heat. And yet the government could not simply announce a rescue. Such an admission would be its own kind of catastrophe, an acknowledgement that the system was far more fragile than the public had been allowed to understand. Instead, what followed through the early and middle weeks of summer was a quiet intervention, a series of careful steps designed to shore up the companies without admitting that they were failing. In July of 2008, Congress passed legislation that expanded the Treasury's authority to support Fannie Mae and Freddie Mac. The language was technical, almost deliberately obscure in its precision, but what it meant was simple. If necessary, the government would lend money to these companies. It would inject capital. It would, in other words, save them, though the word save was never used. The bill passed with surprisingly little public attention, perhaps because the machinery of government had become practiced at disguising enormous financial interventions as routine legislative housekeeping. Paulson and his team worked through June and July in a state of controlled urgency, consulting with the boards of Fannie Mae and Freddie Mac, negotiating the terms of what was coming, preparing the public for a shock that had to be delivered but could not be admitted too early or too loudly. There were late nights in the Treasury building, conversations with congressional leaders, careful calibration of every word that would be spoken and every action that would be taken. The goal was always the same: prevent panic, maintain confidence, and buy time for the market to heal itself, or at least to adjust to its new reality. On September 6th, which would come sooner than the summer seemed to allow, the government would finally move, placing both companies under conservatorship, a financial equivalent of placing them into protective custody. It would inject vast sums of capital, ultimately reaching amounts that would dwarf even the Bear Stearns rescue. Shareholders would be devastated, executives would be removed, and ordinary Americans who had bought stock in what they believed were government-backed institutions would see their investments vaporize almost overnight. But in the middle weeks of summer, that moment was still approaching, still uncertain. The government was working to prevent the worst-case scenario from materializing, moving with a kind of desperate grace, making decisions that would save the financial system but would also, in the eyes of many, represent an enormous inequity. Banks and investment firms received bailouts. Workers and homeowners received messages about personal responsibility. The summer heat continued, indifferent to all of this, and in the space between the failure of Bear Stearns and what was coming next, the world held its breath. As summer faded into early September of that year, the attention of every major bank, every government official, and every trader watching the screens turned toward a single name: Lehman Brothers. It was one of the oldest investment banks in America, founded in the 1840s, and it had survived wars and recessions and the Great Depression itself. Yet somehow, in those final days of summer 2008, it found itself running out of time and running out of money and running out of the faith that other banks were willing to lend it. The weekend before the fall began like many others in the crisis, with frantic phone calls and hastily arranged meetings in windowless conference rooms where powerful men and women tried to imagine solutions to what seemed like the unsolvable. Lehman's executives knew that their bank was in trouble. Its balance sheet was weighted down with mortgages and mortgage-backed securities that were worth far less than the bank had paid for them. And as the summer progressed, as Bear Stearns had fallen just months earlier, as credit continued to seize up throughout the financial system, other banks began to lose faith in Lehman's ability to survive. Why would they lend money to a bank that might not exist in 3 months? On that Sunday, the 14th of September, the Federal Reserve orchestrated what became known as one of the most intense negotiating sessions in modern financial history. Hank Paulson, the Treasury Secretary, Ben Bernanke, the Fed Chairman, and Tim Geithner, who led the Federal Reserve Bank of New York, gathered with the heads of America's largest banks in a conference room at the Fed's headquarters on Liberty Street in Manhattan. They were looking for a solution, some way to save Lehman, or at least to break it apart in an orderly fashion that wouldn't destroy the entire financial system. Perhaps another bank would acquire Lehman. Perhaps a consortium of banks would together provide a bridge loan. Perhaps the Federal Reserve itself could intervene directly. But as the hours passed through that long Sunday afternoon and into the evening, as dozens of people worked the phones and crunched the numbers, it became clear that Lehman was probably going to fail. No bank wanted to absorb the full weight of Lehman's toxic assets. The government, perhaps fearful of setting a precedent of unlimited bailouts, declined to inject capital directly. And the calculations showed that there simply wasn't a neat or clean way to prevent what everyone in that room had feared since the beginning of August. It's worth pausing here to consider what this moment felt like to those people gathered in that room. They were experienced traders and negotiators and government officials, and yet they were engaged in an activity that had never quite been normal in their professional lifetimes. They were, in fact, presiding over the controlled demolition of one of the largest financial institutions in the world. They were making decisions that would ripple through pension funds in Iowa and retirement accounts in Australia, and the savings of millions of ordinary people who had no idea this conversation was even happening. In the hours before the formal announcement, there was what one can only describe as a kind of silence. Not a sound exactly, but the absence of the usual hum of activity, as if even the markets themselves were holding their breath. By Monday morning, when Lehman Brothers announced that it would file for bankruptcy protection, the financial world had to confront a truth that it had been avoiding for months. Not even the oldest, most established banks were safe. The shockwave that followed was felt almost instantaneously across global markets. In London and Tokyo and Hong Kong, where the trading day had already begun or was just beginning, screens flashed with news that seemed almost impossible. The largest bankruptcy in American history had just occurred. A major financial institution had been allowed to fail. And if Lehman could fail, then what other bank might be next? The fear that gripped the markets in those hours and days was of a quality that is difficult to convey with words alone. It was not merely the rational calculation that Lehman had been heavily interconnected with other banks, that money lent to Lehman would never be repaid, that losses would cascade through the system. It was something deeper and more primal. It was the fear that the entire architecture of modern finance might be unstable, that the trust upon which all transactions depend had been fundamentally damaged, that no institution was truly safe. In New York, traders reported feeling almost physically ill as they watched the markets digest the news. The stock market, which had already been volatile and declining, began to fall more sharply. Credit markets, which were already stressed, became actively hostile. Banks that had been lending to other banks, that had been fueling the ordinary transactions of the global economy, began to withdraw from lending altogether. Why would you lend money to another bank when you yourself might be the next to fail? The effects radiated outward with astonishing speed. Money market mutual funds, those supposedly safe instruments where ordinary investors parked their savings, began to come under pressure as it became clear that some of them had exposure to the institutions that were now failing. Pension funds, corporate treasuries, municipal governments, university endowments, all of them suddenly discovered that their supposedly stable holdings were marked to uncertain values, that the institutions they had entrusted with their money were themselves in jeopardy. Across the Atlantic, in London and Frankfurt and Amsterdam, the financial world was confronting not just the failure of an American bank, but the realization that the American financial system itself might be unraveling. European banks had their own exposure to these toxic assets, to these mortgage-backed securities and derivatives that had spread like invisible cracks through the entire global financial structure. Regulators in Britain and Germany and France found themselves in urgent conversation with their American counterparts, trying to understand the scope of the contagion, trying to determine which of their own banks might be vulnerable. The London interbank offered rate, the rate at which banks lend to each other, and the foundation upon which trillions of dollars worth of financial transactions rest, began to move in ways that suggested panic. Higher rates meant that banks were becoming more reluctant to lend to each other, that trust was evaporating, that the lubricant of the entire global financial machine was drying up. In those first hours and days after Lehman's collapse, there was a quality of unreality to the proceedings. Traders later described the experience of watching it unfold as something akin to watching a building collapse in slow motion. You see it happening, you understand intellectually what is occurring, but something in your mind resists the reality of it. This was not supposed to be possible. This was not how the system was supposed to work, and yet it was working precisely this way, and there seemed to be no authority with sufficient power to stop it. The phones in government offices from Washington to Tokyo rang continuously through those dark hours. The Federal Reserve held emergency meetings. Central banks around the world coordinated their response. And yet, for all of this activity, all of this high-level concern, there was a sense that the authorities were working with incomplete information, that they were several steps behind events, that they were responding to crises rather than preventing them. In the days that followed, as word came that other institutions were in distress, as the government began to contemplate what would become the largest economic intervention since the Great Depression, the markets entered what would come to be called the panic phase of the crisis. Stocks lost a quarter of their value in weeks. Credit froze. And across the world, in modest homes and apartments and office buildings, millions of people began to understand that something fundamental had changed, that the prosperity they had assumed would continue indefinitely had been revealed as more fragile than anyone had imagined. In the days that followed, something strange and quiet descended upon the world's financial centers. It was not chaos exactly. Chaos would have been easier to bear, but rather a kind of paralysis, a collective holding of breath that seemed to freeze even the air in the great trading rooms of London, Frankfurt, Tokyo, and Shanghai. The telephones kept ringing, of course. They never stopped ringing, but the voices on the other end carried a tone that traders had never quite heard before, a careful, almost whispering quality, as if they were afraid that speaking too loudly might shatter what little remained intact. Within hours of Lehman's filing, the machinery of global finance seized up like a heart in sudden arrest. Banks stopped lending to each other. This might sound like a minor inconvenience to those outside the industry, but it was in fact the moment the world's circulatory system began to fail. Every single day, banks rely on short-term loans from one another, overnight loans, 3-day loans, week-long loans, to maintain their operations. It is the oil that keeps the gears turning. And on that September morning, the oil simply drained away. No bank knew which of its peers might fail next. Lehman had seemed solid until it wasn't. So who could be trusted? Who was hiding the next catastrophe in their vaults? The credit markets froze. This is not metaphor. The LIBOR rate, the London interbank offered rate, the interest rate at which banks lend to each other, shot upward in a kind of panic. Banks were asking for higher and higher rates from each other, a risk premium that reflected their genuine terror. Some lending windows simply closed. Institutions stopped answering calls from smaller regional banks entirely. The great forest of credit that had been so abundant just weeks before had transformed into a desert, and everyone was scrambling for water that no longer flowed. Think of it this way. Imagine a vast irrigation system feeding an entire civilization, one built so intricate, so interdependent, that no single person fully understands how all the channels connect. Now imagine that someone suddenly turns a valve, not violently, but decisively, and the water stops moving. Crops don't fail instantly, reservoirs don't empty at once, but everything slows. The question changes from abundance to scarcity, and scarcity breeds a very particular kind of fear. In Washington, in London, in Frankfurt, the telephone lines burned day and night. Treasury secretaries and central bank governors began placing calls to one another with a frequency that suggested the world might, quite literally, be ending. Hank Paulson, the American Treasury Secretary, a man who had spent decades in finance and prided himself on his calm demeanor, began speaking to other finance ministers with an undertone of something close to desperation. The conversations were measured on the surface, tone carefully controlled, language precise. But beneath that formality ran something more urgent. They were all asking the same question, perhaps not aloud, but certainly thinking it. How do we stop this? The British Chancellor Alistair Darling was fielding calls from around the world. The Bank of England, led by Mervyn King, convened emergency sessions. The European Central Bank's Jean-Claude Trichet found himself coordinating not just with other central banks, but with political leaders who suddenly realized that their economies were connected to American mortgage bonds in ways they had never fully grasped. How many Greek banks held toxic American assets? How many French institutions had invested in funds that were now worth nothing? The questions multiplied. The answers became harder to find. What no one wanted to say aloud, but what everyone was thinking, was that a complete financial system meltdown was not only possible, it was happening in real time. The Great Depression had been blamed, in part, on a lack of international coordination, on central banks tightening money when they should have loosened it, on countries turning inward when they should have cooperated. And so now, 70 years later, the lesson had been learned. These financial leaders would cooperate, they would talk, they would act, but they were racing against a clock that was ticking faster than their ability to respond. Meanwhile, in the real world, something equally eerie was unfolding. Global trade, the vast, intricate web of containers and cargo ships and freight planes that moved goods from factory to port to retailer, began to stall. This requires explanation, because it is counterintuitive. A financial crisis is abstract, numbers on screens, electrons moving through networks. Why would it affect the physical movement of goods? The answer lies in something called trade finance. When a manufacturer in South Korea wants to ship electronics to a distributor in Brazil, the Brazilian buyer typically doesn't pay cash up front. Instead, a bank issues what's called a letter of credit, essentially a guarantee that the money will be there when the goods arrive. This system had been working seamlessly for decades. Every day, hundreds of billions of dollars in goods moved on the faith that these letters of credit were sound. But in September 2008, banks stopped honoring letters of credit. Which bank could be trusted to guarantee anything? If Lehman Brothers had failed, surely others might too. And if a bank failed after guaranteeing a shipment, but before paying for it, the exporting company lost everything. So the ships began to wait. Not all at once, but gradually, the great dance of global commerce began to move in slow motion. A container ship scheduled to leave Shanghai might sit docked for an extra week. A refrigerated cargo plane destined for Rotterdam might be delayed. Ports that had hummed with round-the-clock activity found their busy work slightly reduced. It was as if the whole world had taken a breath and was holding it, uncertain whether breathing out again would be safe. The silence was what struck observers most profoundly. In previous crises, there had been sound, the roar of selling, the shouts on trading floors, the sense of motion. But this was different. This was the sound of fear, so absolute that it had paralyzed noise itself. The trading floors were still active, yes, but in a reduced way. The frenetic energy had been replaced by something more methodical, more grim. People stared at screens that showed red numbers. They picked up phones. They put them down. They waited. In airports around the world, The passenger boards began to show fewer flights. Travel bookings dropped as companies stopped sending their executives on trips. Spending slowed, not because of any official decree, but because people, everywhere, had received a signal, wordless but unmistakable, that the world had changed. Spend less, hold tighter, trust nothing that isn't absolutely essential. The stock markets of the world were in free fall. From September into October, the losses accumulated in a way that seemed almost mechanical in its ruthlessness. Every day brought new lows. Every morning, investors would wake to news from the previous night's Asian trading. Every evening, Europe would add its own chapter of decline, and when morning came again in New York, the selling would resume. It was as if gravity itself had suddenly reversed, and all the stored value of years was being pulled downward through the thin air. And beneath all of this, beneath the phone calls, the frozen markets, the silent ports, the falling indices, there was something else. There was the dawning realization that this was not a moment of correction. This was not a market adjustment that would be resolved in a matter of weeks or months. This was the beginning of something far larger, far more consequential. This was the beginning of a reckoning. Yet for all the complexity unfolding in those gleaming towers, something far more intimate was already taking root in the quiet of suburban homes and small storefronts across the country. While the mechanisms of collateralized debt obligations and credit default swaps were being dissected in academic papers and boardroom presentations, ordinary families were beginning to understand, in the stillness of evening, that the ground beneath their lives was shifting. Consider the experience of a woman named Margaret. Though there were millions like her, she had purchased her home in 2005 with an adjustable rate mortgage at 2.5%. The payments seemed manageable then, almost easy. She worked as a dental hygienist, a steady profession, and her husband held a position at a manufacturing plant. They were not wealthy, but they were careful. They believed that home ownership was a stable thing, something that only moved upward over time. That was what everyone said. That was what the bank had said when they signed the papers in a quiet office that smelled of coffee and photocopier toner. Then, in 2007, that rate began to adjust. The payment rose from $980 a month to $1,430. It rose again in 2008 to $1,700. Margaret began to do the mathematics late at night, sitting at her kitchen table with a calculator and papers spread before her like some kind of impossible puzzle. Her husband tried to find overtime at the plant. The plant was cutting hours instead. By autumn of 2008, their home, once a source of quiet pride, had become an anchor. The value had dropped by $40,000. They owed $190,000. The rational choice began to whisper itself, walk away. This was not an isolated story. Across Florida and Arizona and California and Nevada, neighborhoods that had thrummed with the quiet satisfaction of aspiration began to hollow out. Foreclosure signs appeared on lawns with a frequency that would have seemed impossible only months before. Empty houses accumulated. Some stood vacant for months, their windows becoming dark eyes watching the street. Others were claimed by vandals or by the simple entropy of abandonment. The people who had lived in them dispersed, moving back in with parents or aunts, renting small apartments, carrying their diminished circumstances with the peculiar shame of a failure that was not their own. The National Association of Realtors would later report that in 2008, foreclosures reached 890,000. That number, so large it becomes almost abstract, contained within it 890,000 stories of disruption, of plans unmade, of children changing schools, and marriages fraying under the weight of financial desperation. One might ask, what happens to a child when they must tell their friends they are moving again? What small devastations accumulate in the quiet car rides to a new neighborhood? The losses extended far beyond the walls of single-family homes. Pensions, Those instruments of deferred security that workers had accumulated through decades of steady employment began to contract. A schoolteacher who had been promised a comfortable retirement found that fund diminished by 30, sometimes 40, sometimes 50%. The calculations that had been done at age 30, projecting forward to 65, suddenly became obsolete. The future had to be rewritten. Retirement dates slipped backward. Vacations that had been planned were cancelled. The quiet knowledge that one had been building toward a particular future, and that future had simply vanished, created a particular kind of psychological vertigo. In the manufacturing districts of the Midwest, small business owners who had never thought of themselves as part of the financial system began to experience its collapse as something immediate and devastating. A man who had run a tool and die shop for 32 years found that his bank, which had been stable for a century, had failed. The line of credit that had allowed him to manage the seasonal variability of his business simply ceased to exist. Lenders withdrew. Credit became impossible to obtain. Without capital to maintain inventory or pay workers, the shop began to close. 12 people lost their jobs. The man, aged 58, found himself unemployed for the first time in his adult life, watching the business his father had founded be liquidated for a fraction of its value. These were the moments that the news media began to capture in late 2008 and early 2009, though the cameras could not quite contain what they showed. An unemployed construction worker standing in an empty warehouse, his hard hat still dangling from his hand. A woman opening letters from her pension fund, reading the updated balance with an expression that combined disbelief with a growing, terrible clarity. A family sitting in a sparse apartment, boxes still unpacked, the mother explaining to her children that they would not be going back to their old school. What is it that disappears in such moments? One might think it is only money, but that is perhaps too narrow. What evaporates is a kind of social trust, a collective agreement that if you work, if you are careful, if you follow the implicit rules, then certain things are supposed to remain stable. Your home, your pension, your job, the assumption that tomorrow will at least resemble today. When these assumptions collapse simultaneously across millions of households, something deeper than financial architecture is affected. In many cases, the people who experience these losses had absolutely no role in creating the systems that failed them. A retired auto worker in Michigan had not structured complex mortgage securities. A nurse had not underwritten subprime loans. Yet their pension funds had been invested in markets that contained these poisons. Their portfolios, modest though they were, had been exposed to the same cascading failures that brought down investment banks. The market is democratic in this way, indiscriminate in its distribution of consequence. It touches the high towers where decisions are made and the small apartments where those decisions are eventually felt. There was also something quietly insidious about the timing of these individual collapses. They did not happen all at once, which might have produced a kind of unified shock. Instead, they accumulated through 2008 and into 2009, a slow-motion wave of personal crises that unfolded across neighborhoods and families. Each person felt, in their own enclosed circumstances, that they were perhaps uniquely unfortunate, even as millions experienced the same dissolution simultaneously. The isolation of private failure made it somehow deeper. One did not fall with the market. One fell alone, in the quiet dark of one's own circumstances, watching the news and wondering how something so large and so distant had become so intimately personal. As the calendar turned to October 2008, something remarkable and unsettling unfolded in the corridors of power. The people who governed the world's largest economy faced a choice that few had ever contemplated in quite this way. On one side lay the traditional doctrine of letting markets correct themselves through failure, a belief held so deeply that some called it almost religious. On the other side lay an abyss, a genuine fear that if they did nothing, the entire global financial system might simply cease to function. Treasury Secretary Henry Paulson, a former Goldman Sachs chief executive, found himself in a position of extraordinary burden. He had moved through the autumn, knowing that each weekend brought new catastrophe. Bear Stearns had been rescued with a government backstop months earlier. Lehman Brothers had been allowed to fail just days before, a decision that now seemed to have opened a terrible door. Paulson understood, with a clarity that perhaps only a handful of minds in government possessed, that the financial system did not merely move money around, it was the very circulatory system of modern commerce. Without it functioning, ordinary commerce would simply stop. And so, in mid-September 2008, Paulson and Federal Reserve Chairman Ben Bernanke approached Congress with a proposal that would have seemed unthinkable just months before. They asked for $700 billion, not to invest, not to spend on infrastructure or social programs, but to purchase the very instruments that had poisoned the system, the mortgage-backed securities and other toxic assets that now sat on the books of banks across the country, unmarketable and unsellable, yet somehow worth something only if the government decided to value them. They called it the Troubled Asset Relief Program, or TARP. The name itself was almost gentle, almost administrative, when what was being proposed was fundamentally a reshaping of the relationship between capitalism and the state. Paulson presented it to Congress as an emergency measure, a 3-page proposal that seemed almost absurdly brief for what it proposed to do. He asked for authority to deploy these funds with minimal oversight, arguing that the speed of deployment mattered more than traditional deliberation. In ordinary times, such a request would have been laughed at. These were not ordinary times. Congress, however, was not made to move at the speed of crisis, and the initial response was rejection. Representatives from districts that had been devastated by the financial crisis's early waves, foreclosures spreading like a quiet stain across the American heartland, balked at the idea of using taxpayer money to rescue Wall Street. There was something almost metaphysically troubling about the proposal. The people whose recklessness had created the crisis would be protected by the people whose houses were being taken from them. The debate that followed happened partly in public, on Capitol Hill and in news programs, and partly in the hidden chambers where real power operated. Paulson and Bernanke held what amounted to intervention sessions with lawmakers, explaining with a kind of urgent gentleness that the alternative truly was systemic collapse. If credit seized up completely, if no bank would lend to another bank, if the overnight lending markets that kept the system fluid simply froze solid, then within days, the real economy would face a crisis beyond anything witnessed since the Great Depression. Payroll systems might fail, supply chains would rupture. The ATM machines from which ordinary people drew cash might simply run dry. These conversations happened through sleepless nights. Bernanke had been studying the Great Depression for decades, and he did not need to imagine what happened when credit vanished. He had read the accounts. Paulson carried the weight of knowing that if they failed to act, millions might lose their jobs, their homes, their sense of security. Yet if they acted, they would be rewarding what many saw as spectacular corruption and incompetence. There was no path through this choice that did not involve profound moral discomfort. Congress eventually revised TARP and passed it, though the vote was close and the bitterness was palpable. The first version of the bill failed in the House, and a second attempt was necessary. What emerged was the Emergency Economic Stabilization Act of 2008, signed into law on October 3rd. The language was careful, the restrictions somewhat tighter than Paulson had initially sought, but the essential authority remained. The government now had the power to buy hundreds of billions of dollars of troubled assets from banks. What happened next, however, was peculiar and somewhat unexpected. Rather than immediately deploying the full amount to purchase toxic mortgage-backed securities as originally outlined, the Treasury Department Now working under new leadership as the administration shifted, modified the approach. Bank executives, when given the choice between having the government buy their bad assets at fair market value, which would mean acknowledging tremendous losses, or having the government inject capital directly into their institutions through preferred stock purchases, largely chose the latter. It was faster, it was cleaner, and it allowed the banks to avoid the detailed accounting that would have exposed the full depth of their problems. The irony, though it would take time for many to recognize it, was that this modification made the program less punitive to the banks, even as it was meant to stabilize them. The government essentially lent money to financial institutions, which did little to restore real lending into the broader economy. Banks hoarded the capital, shoring up their balance sheets and preserving their own survival, but they did not immediately rush to lend to businesses and households that were now desperate for credit. This created a strange and shadowed landscape. The government had intervened with unprecedented force to prevent complete financial collapse. The system had been stabilized, in the narrow sense that major financial institutions did not go under, and the banking system did not disintegrate entirely. Yet the paralysis remained. Credit remained tight. Unemployment continued to climb. For millions of ordinary people, the rescue felt less like salvation and more like a betrayal. The banks had been saved while they were left to weather the storm alone. And yet, there was a logic to the intervention that, while painful and contradictory, was perhaps inescapable. Had the government not acted, had Lehman Brothers not been the only major institution allowed to fail, had TARP not existed to provide a firewall against the complete destruction of the financial system, the story that followed would have been incomparably worse. This is not a statement that eases the conscience of those who had their homes foreclosed while banks were rescued. It is simply an observation about the nature of the choice that faced the people in those sleepless nights of October 2008. Paulson and Bernanke and the other architects of the emergency response made decisions that prioritized the functioning of the financial system itself over the complete punishment of those who had broken it. Whether that was the right choice remains one of the most contested questions in modern economics and politics. What is certain is that they believed, in the small hours when they worked, that not acting would have meant a collapse so profound and so rapid that the ordinary machinery of modern life would have frozen entirely. And in a system as interdependent and interwoven as the global economy, that belief, right or wrong, felt like the only logic available to them. The tremor that began in New York and London did not stop at the Atlantic. It rippled outward with a quiet, inevitable force, reaching into corners of the world that seemed impossibly distant from Manhattan's collapsing towers. And in those distant places, it found vulnerabilities that had been quietly building for years, waiting only for the right moment of fear to become visible. Consider Iceland, a small island nation in the North Atlantic, where the financial dream had taken a particularly intoxicating form. In the early years of the new millennium, Iceland's three largest banks, Kaupthing, Landsbanki, and Glitnir, had grown with astonishing speed, their assets swelling to nearly 10 times the nation's entire economic output. They had borrowed heavily in international markets, using cheap credit to fuel an expansion that seemed almost miraculous. Icelanders, watching their nation transform into a financial powerhouse, began to believe that they had discovered something others had missed, some secret formula for prosperity that would keep them insulated from the ordinary cycles of boom and bust. But when Lehman Brothers fell in September, and confidence in global banking evaporated like morning dew, Iceland's banks faced a problem they had never truly considered. They had borrowed dollars and euros to lend kronur, and suddenly the foreign currency markets seized. No one would trade with them. No one would lend them the money they needed to survive even a single day. Within weeks, all three banks had collapsed. The Icelandic government, tiny and unprepared for such a catastrophe, declared a national emergency. The currency fell sharply. Families who had borrowed in foreign currencies found their debts had effectively doubled overnight. The nation, which had seemed so confident just months earlier, faced a genuine possibility of bankruptcy. It was a small cautionary tale, but one watched closely by other nations who recognized in it the shape of their own precarious position. For across Europe, beneath the surface of apparent stability, similar pressures had been building. The continent had grown dependent on a delicate interconnection of credit and currency that worked beautifully when confidence remained intact, but which could unravel with terrifying speed once doubt crept in. Banks in Germany and France and Austria had loaded themselves with mortgage-backed securities and other American financial instruments, assuming that American real estate, backed by Federal Reserve guarantees and the sheer size of the American economy, could never truly fail. They had borrowed short and lent long, a strategy that required an uninterrupted flow of new credit to survive. When that flow stopped, they found themselves trapped, unable to refinance, unable to move money between borders with any confidence. And there was another, deeper problem simmering quietly beneath the continent's surface. Several European nations, Greece most prominently, but also Portugal, Spain, and Ireland, had accumulated substantial government debts and persistent budget deficits. For years, this had not seemed to matter much. The adoption of the euro had created an assumption that all euro-denominated debt was equally safe, that the creditworthiness of a Greek government bond was essentially the same as a German government bond. Interest rates across the eurozone converged toward the same low levels. Ireland and Spain in particular had experienced enormous property booms, fueled by cheap borrowing, and their governments had grown accustomed to surging tax revenues that seemed to arrive without effort. But those revenues had rested entirely on the continuation of the property boom. When prices began to fall, when construction stopped, when unemployment began to rise, tax revenues collapsed. Suddenly, governments found themselves with shrinking income but fixed or growing obligations. They had to borrow more to cover their deficits. And now, as confidence in banks evaporated, investors began to ask harder questions about whether governments themselves could repay their debts. The European sovereign debt crisis, as it would come to be called, did not fully explode until later, in 2010 and beyond, but its roots were feeding in the dark soil of 2008 and early 2009. Greece's statistics, which had been presented for years with a kind of cheerful optimism, were quietly revealed to have been falsified. The deficit was far larger than anyone outside the government had realized. Investors, burned by the Lehman collapse and the general seizing up of credit markets, began to demand much higher interest rates to lend Greece money. It became a self-reinforcing cycle. Higher borrowing costs made the deficit larger. A larger deficit meant investors demanded even higher rates. The cost of insurance against Greek default, the price of credit default swaps, began to climb toward levels that suggested the market thought default was likely. Similar pressures were building in Ireland, where the banking system had become hopelessly intertwined with the property sector and with the government itself. When the banks needed rescuing, the government had to borrow enormous sums to bail them out, and that pushed the government itself toward the edge of insolvency. What was happening, in effect, was a crisis of confidence spreading like a slow wave across the entire financial architecture of the developed world. It had begun with the recognition that American mortgages were not safe. That realization had extended to the global banks that held those mortgages. And now it was extending further, to the sovereign governments themselves that stood behind those banks, that had to rescue them with public money. The assumption that government debt was safe, an assumption that had lasted for so long that it had become almost invisible, was beginning to crack. If the government had to rescue the banks, and the banks were enormous, and the government's own finances were shaky, then what exactly was safe anymore? It was a question that would keep policymakers awake through the nights to come, and it would reshape the political landscape of Europe for years to come. The contagion moved differently in each direction. In Latin America and Asia, the initial shock came more through the sudden reversal of capital flows. For years, investors had been eagerly seeking higher returns in emerging markets, pouring money into stock markets and government bonds in Brazil, Mexico, Russia, China, and beyond. When the crisis hit the developed world, those investors suddenly wanted to pull their money back to safety, to take their savings out of risky places and move them into government bonds from countries with perceived stability. The resulting capital flight triggered currency collapses and stock market crashes in nations that had been growing briskly just months earlier. It was an eerie reminder that in a globalized financial system, no economy is truly isolated. The collapse of confidence in New York rippled across oceans and time zones with a speed that had seemed almost impossible even a decade earlier. The sense, growing through the autumn of 2008 and into 2009, was of a system fundamentally broken, awaiting only the decisions of governments and central banks to determine whether it would recover or continue its descent into darkness. What happens inside the human mind when trust dissolves? It is a question that matters far more than any spreadsheet or graph, because in the end, the financial system runs on something far more fragile than mathematics. It runs on belief. And belief, once fractured, behaves almost like physics. It travels, it spreads, it finds its way into the deepest chambers of our reasoning, and it changes everything. Imagine, if you will, the ocean at the moment just before a great storm arrives. The tide begins to recede from the shore in an almost imperceptible way. The water withdraws as if the earth itself were breathing inward, pulling the familiar rhythm away from the sand and rocks that have held it for centuries. To someone standing at the water's edge, this withdrawal feels wrong. It feels unnatural. And in that moment of wrongness, something primitive awakens in the human body, something that knows, without knowing why, that the ocean does not simply give back its water without taking something else in return. The wave is coming. This is precisely what happened in the fall of 2008, except the ocean was made of money and the shore was made of institutions that had stood so long and so solid that no one quite believed they could be swept away. But the withdrawal began, slowly at first, a hesitation here, a whispered doubt there, and then, as the days passed, the water retreated faster. Banks, you see, operate on a principle so elegant that it is almost invisible in its daily workings. They take deposits from ordinary people, your savings, your paycheck, your grandmother's inheritance, and they lend that money out to others who need it. On any given day, most of that money is out in the world. It has left the bank. It is in someone's mortgage, someone's business loan, someone's automobile debt. The bank keeps only a fraction in reserve, the amount it believes it will need for the everyday withdrawals that people make. This fraction is usually quite small, because statistically, most people do not withdraw all their money on the same day. Why would they? Their money is safe in the bank. It is insured by the government. It earns a modest interest. There is no reason to panic. Unless there is a reason to panic. And in September and early October of 2008, reasons to panic began appearing on every television screen and in every email inbox. Bear Stearns had already fallen. Lehman Brothers had collapsed in the most dramatic fashion. Merrill Lynch had been forced into an emergency marriage with Bank of America. And suddenly, ordinary people, not just investors, not just financiers, but people with regular jobs and families and mortgages of their own, began to ask themselves a question that most people never ask. What if my bank does not have enough money? What if my bank fails? This is the beginning of what economists call a bank run, though that clinical phrase hardly captures the urgency and the fear that animates it. When trust evaporates, behavior changes. When people believe that a bank might not have enough reserves to pay back their deposits, the only rational thing to do becomes irrational in aggregate. It becomes rational for you to run to the bank and withdraw your money immediately, before everyone else does. Never mind that your withdrawal makes the problem worse. Never mind that if everyone runs to the bank at once, the bank will certainly fail because it will not have enough cash on hand. The logic is simple and it is primal. I want my money. I want it now. I do not trust that it will still be there tomorrow. And so the water recedes faster. The withdrawals accelerate. The banks, which depended on the faith that most people would leave their money untouched, suddenly find themselves facing a liquidity crisis, not because their assets are worthless, but because they have been unable to instantly convert those assets into cash. A bank can own a building worth millions of dollars. It can own loans secured by mortgages. It can own bonds and securities and all manner of paper that theoretically has real value. But if you walk in and demand your money in cash, and 10,000 other people do the same thing, the bank has no way to produce that cash quickly enough. The building does not instantly become bills. The loans do not instantly become currency. And this is where fear and mathematics collide. In the autumn of 2008, this collision was happening everywhere. Washington Mutual, one of the largest banks in the American West, experienced the largest bank run in the history of the United States. Over 10 days in late September, depositors withdrew nearly $17 billion. The bank simply could not supply the cash. The institution that had stood for over a century simply ceased to exist. It was taken over by the government and sold to JP Morgan Chase at a tiny fraction of its previous worth. And as one bank fell, the fear spread to others. People wondered which bank would be next. Would their own bank survive the night? This is the deep psychology of financial collapse, and it reveals something important about the nature of modern money itself. Modern money, after all, is not actually anything. It is not gold. It is not goods. It is not even paper anymore. Not really. It is confidence. It is the agreement between you and the bank and everyone else that this number in a computer represents something real, that if you need it, you can have it, that it will be there tomorrow, that the institution holding it is solid. Withdraw that agreement, and the number becomes nothing. It evaporates. But confidence, unlike money itself, does not behave in orderly ways. It is not rational. It is contagious. Fear spreads like a tide, and it travels fastest in darkness, when people cannot quite see what is real and what is illusion. Throughout October 2008, people could not see. The darkness was genuine. No one knew which banks were truly insolvent and which were merely facing temporary liquidity problems. No one knew if the government would actually protect deposits. No one knew if the interventions being planned would work, or if they would be too little, arriving too late. And in that darkness, fear multiplied. The governments of the world eventually stepped in with explicit reassurances. Deposit insurance was increased. Extraordinary lending facilities were created. Central banks announced that they would provide unlimited liquidity to solvent institutions. Slowly, very slowly, the tide began to stop its retreat. The panic began to ease. But even as it did, something had changed in the collective mind. Trust, once broken, takes years to rebuild. It is far easier to lose than to regain. And the memory of that moment, when the ocean pulled back, when the great wave seemed inevitable, when the oldest and most solid institutions revealed their fragility, that memory would linger for decades in the dreams and decisions of ordinary people. As the year turned from 2008 to 2009, the world found itself in a peculiar kind of silence. The markets had stopped screaming. The emergency calls had quieted to a steady hum, and yet everything remained suspended, caught between the terror of the collapse and the fragile hope that perhaps, just perhaps, We had not fallen all the way to the bottom. The work of stabilization had begun in those final weeks of 2008, but 2009 would become the long, patient year of coaxing a broken system back to breath. The first major intervention came in the form of stimulus. In February, the American Congress passed the American Recovery and Reinvestment Act, a $831 billion package designed not to repair what had broken, but to inject money directly into the veins of an economy that had begun to hemorrhage employment and demand. The logic was simple, though not always visible to those living through it. If families had money, they would spend. If they spent, businesses would sell. If businesses sold, they would hire. If they hired, more families would have money. A circle, turning again. The machinery of government began to move with unusual urgency. Stimulus checks were printed and mailed. Tax credits were distributed. Infrastructure projects that had languished on drawing boards for years suddenly received funding. Roads that might have remained potholed were repaired. Schools that might have cut teachers instead retained them. It was not glamorous work. It was not the kind of thing that made headlines after the first few weeks. And perhaps that was its quiet genius, not to dazzle, but simply to slow the bleeding long enough for clotting to begin. Meanwhile, the central banks, those ancient institutions that hold the power to create money itself, had been working through the winter nights with an intensity few understood. The Federal Reserve, led by Ben Bernanke, had already dropped interest rates to nearly zero. But when interest rates reach zero, traditional monetary policy runs out of ammunition. So they invented new weapons. They began buying vast quantities of bonds and mortgage-backed securities directly from banks. They called it quantitative easing, though the name mattered far less than the mathematics. Billions of dollars flowing into the system, not as loans, but as pure injections of liquidity. The banks, drowning in worthless assets, could now exchange them for cash. Cash was the universal language of trust, in a moment when trust had nearly died. Other central banks around the world watched, and then followed. The European Central Bank, the Bank of England, the Bank of Japan. They all began the delicate work of creating money, of expanding their balance sheets to sizes they had never reached before. It was a kind of coordinated breathing exercise, performed across continents by men and women in dark suits, speaking in languages of currency and decimal points. By spring of 2009, the first fragile signs of stabilization began to emerge, though they were easy to miss beneath the still heavy gloom. The rate of job losses slowed. The unemployment rate, which had been climbing steeply each month, seemed to be approaching a plateau, though it would remain high for years to come. The stock market, which had fallen nearly 60% from its 2007 peak, began a tentative climb. Not a roar of recovery, not a celebration, just a slow, tired ascent, like a swimmer whose lungs are still burning but who has finally broken the surface of the water. Home prices, which had been plummeting like stones thrown into deep water, began to stabilize in some regions. Not everywhere, not immediately, but the free fall seemed to have ended. Foreclosures continued, and they would continue for years. The backlog was enormous. The pain was real, but the velocity of collapse was decelerating. The curve was flattening. In April, the stress tests came. The government announced that it would examine the nation's largest banks to determine whether they had enough capital to survive further deterioration. The tests were rigorous, but also carefully calibrated. The government needed the banks to survive. The entire payment system depended on them. But the public needed to believe that the banks were actually being scrutinized. It was a delicate dance between confidence and accountability. Most of the banks passed. Some required additional capital. A few quietly merged with stronger competitors. By summer, the major banks had begun to stabilize. Some even reported quarterly profits again, though those profits were often modest and sometimes questioned. There was something almost dreamlike about the recovery in 2009. because it unfolded beneath a surface of continued pain. Unemployment remained above 9% through most of the year. Homes continued to be lost. Small businesses continued to fail. The number of Americans in poverty rose, and yet, at the level of institutions, at the level of the financial system that had nearly ceased to exist, something had shifted. The bleeding had slowed. The panic had eased. The will to survive had expressed itself through policy and money and coordination. Think of it this way. The financial crisis had been an earthquake, violent and sudden. The aftermath of 2009 was not the end of the earthquake. Aftershocks would continue for years, but rather the moment when the instruments stopped recording the violent tremors and began instead to measure a return, however uneven, to stability. The stimulus money, that $831 billion, moved through the economy in ways both visible and invisible. A teacher kept her job. A road got paved. A bank manager could sleep through the night without wondering if the bank would open in the morning. A family, facing foreclosure a few months earlier, received a temporary reprieve when a mortgage modification program gave them slightly lower payments. These were not grand moments. They were the accumulated weight of millions of small salvations. By autumn of 2009, something had shifted in the tone of discussion among economists and policymakers. Not to optimism, not yet, but to something like exhaustion mixed with cautious hope. The worst, it seemed, had passed. The question now was not whether the system would collapse entirely, but how long the recovery would take, how many people would lose their homes before foreclosures stopped accelerating, and whether the unemployment rate would ever return to the single digits. The year 2009 had been, in its own way, as strange as the panic of 2008. Where 2008 had been the year of collapse, 2009 was the year of repair. Not healing. Healing would take longer, much longer, but repair. The broken things were being held together with government money and central bank determination and the quiet coordination of institutions that had learned, in a very painful way, that they had to survive together or fail together. There was no triumph in this. There was only the slow turning of a wheel that had nearly stopped, and the fragile certainty that forward motion, however tentative, was beginning again. As the tremors of September and October faded into November, a different kind of silence fell across the world. The markets had stopped their violent convulsions, but the damage remained visible everywhere. Homes stood empty on quiet suburban streets. Retirement accounts bore hollow numbers, where once there had been comfortable nest eggs. Small business owners, who had survived decades, discovered that decades of accumulated wealth could evaporate in months. A 70-year-old man in Ohio watched the pension he'd earned through 40 years of factory work shrink by nearly half. A woman in Florida found herself holding a mortgage on a house worth far less than she owed, trapped in what economists would call being underwater, a word borrowed from drowning. Entire families relocated across states to find work. The unemployment rate, which had hovered around 5% in 2007, would eventually climb above 10%. These were not abstract numbers on a financial chart. They were lives interrupted, plans deferred, educations postponed. Yet even as the human toll accumulated quietly, something else was already beginning in government offices and legislative chambers across the globe. There was a recognition, slow and reluctant though it may have been, that the system itself had to change. The question haunting every policymaker was almost childlike in its simplicity. How had we allowed this to happen? How had the world's most sophisticated financial system been brought to the edge of complete collapse? In the United States, the response came through legislation. The Dodd-Frank Wall Street Reform and Consumer Protection Act, named after Senator Christopher Dodd and Representative Barney Frank, began taking shape through 2009 and into 2010. It was meant to be a comprehensive overhaul, the most significant financial regulation since the Great Depression. The law was lengthy, complex, filled with provisions and subsections that would themselves require years of interpretation. One of its central pillars was the creation of the Consumer Financial Protection Bureau, a new agency designed to shield ordinary people from the kind of predatory lending practices that had helped inflate the housing bubble. Another piece was the Volcker Rule, named after former Federal Reserve Chairman Paul Volcker, which aimed to restrict the proprietary trading activities of banks, the practice of using their own capital to place bets on markets, rather than serving clients. There was also the Dodd-Frank requirement that derivatives, those complex financial instruments that had helped obscure risk, be traded on public exchanges and held in central clearinghouses. The logic was transparent. Sunshine, it was hoped, would disinfect the shadows where danger had been hiding. But there was something melancholy in how these reforms came to pass. They were written in the aftermath of crisis, drafted by people who had watched trillions of dollars vanish and millions of jobs disappear. They were reactive, not preventative. They were born from damage already done, from learning the lessons of a fire by watching buildings burn. Dodd-Frank itself would become contested political territory in the years that followed, with critics on both sides, some arguing it didn't go far enough, others insisting it throttled the engine of American finance too heavily. The legislation ran to nearly 2,000 pages, and the regulatory rules derived from it would eventually span tens of thousands of pages more. Implementation took years, and some provisions were contested in courts, delayed, or quietly reshaped by changing administrations. Globally, the response was similarly multifaceted but uneven. The Basel Committee on Banking Supervision, an international body of central bankers and financial regulators, developed what became known as Basel III, a set of international standards designed to strengthen bank capital requirements and improve the banking sector's ability to absorb shocks. The idea was that banks had grown too thin in their reserves, too leveraged, too willing to bet the entire foundation of the financial system on ever riskier bets. If they held more capital, if they kept larger safety nets of their own funds rather than borrowing vast multiples of what they actually owned, perhaps the next crisis could be contained before it spiraled outward. The regulations also called for stress tests, for scenarios in which banks would be required to prove they could survive imaginary catastrophes. It was a way of asking institutions to rehearse their own survival before the next real emergency came. The credit rating agencies, those institutions that had placed AAA stamps of approval on mountains of toxic debt, faced their own reckoning. New regulations required them to disclose conflicts of interest and face potential legal liability for ratings they issued. Yet the fundamental problem remained largely unaddressed. The agencies were paid by the institutions whose securities they were rating. It was an inherent conflict of interest, and regulations could only do so much to overcome structural incentives. Some voices argued, and continue to argue, that the entire model of rating agencies needed to be reimagined or replaced. Others suggested that the real problem was not the raters but the users, the people and institutions who had relied too heavily on these ratings rather than conducting their own analysis. Both critiques held weight, and neither could fully resolve the question of how to prevent the next group of financial engineers from finding new ways to obscure risk. What emerged slowly over the years following 2008 was not a new financial system, but a more cautious one. Bank executives became accustomed to regulatory scrutiny they had once deemed excessive. Stress tests became routine, regular exercises where analysts would ask, what if housing prices fell another 30%? What if unemployment spiked to 12%? What if credit markets froze again? The answers had to be satisfactory, or regulators would force banks to hold more capital, to lend less aggressively, to shrink their operations. There was less glamour in banking after 2008, and for a time at least, there was less certainty about unlimited growth. The very idea of too big to fail became a political phrase, a rallying cry for those who believed large banks should be broken up, and a defensive argument for those who insisted that size itself was not the problem, it was the practices that size had enabled. Trust in financial institutions, which had been shattered, slowly began to reconstitute itself, though it never quite returned to its previous state. There was a different kind of relationship between ordinary people and the financial system afterward. More people questioned their mortgages, wondered about the derivatives embedded in their pension funds, paid attention to what their banks were actually doing. Institutions, for their part, began to invest more heavily in public relations and in the appearance of ethical conduct. Compliance departments swelled, training programs proliferated. The culture of finance, or at least its public face, shifted slightly away from the unbridled celebration of profit toward an at least rhetorical commitment to responsibility and risk management. Do these reforms actually prevent the next crisis, or do they only buy time until new forms of risk accumulate in new shadows? That remains an open question, one that economists and financial analysts continue to debate in academic papers and policy forums. What can be said with certainty is that the 2008 crisis changed something fundamental in how the world approaches the regulation of money. It demonstrated that finance is not merely an abstract mathematical game played by clever people, but a system that touches the lives of billions. When it fails not just in balance sheets, but in homes lost and families fractured. And that recognition, painful as it was to acquire, proved to be the most durable legacy of the night when the world's money nearly died. When we pull back far enough to see 2008 not as an ending but as a chapter in a much longer story, something quietly remarkable emerges. The panic, the fear, the sense that the entire architecture of modern finance was crumbling. All of it has echoed before, not identically, never quite the same way, but the pattern, the underlying tremor, it hums through the centuries like a low frequency we only notice when we slow down enough to listen. Consider the tulip mania of 17th century Holland, a moment that still feels almost absurdly distant until you hold it up against 2008 and recognize the same fever in its bones. In the 1630s, Dutch traders became intoxicated by the beauty and rarity of variegated tulip bulbs. Prices soared, fortunes were pledged on flowers that existed only in the spring. People bought and sold contracts for bulbs not yet grown, not yet bloomed, based purely on the certainty that the next buyer would pay more. Then, quietly, the certainty evaporated. The market for tulips collapsed, not with a thunder, but with a whisper. And yet, Holland survived. Its economy continued. The ships still sailed. There is something almost soothing in that historical distance, is there not? The fact that one of history's most lurid examples of speculative excess, which consumed the imagination of generations of economists, proved not to be the permanent unraveling everyone feared. Life went on. Markets learned, or appeared to learn, and moved forward. Then came the South Sea bubble of 1720, when the South Sea Company promised riches from trade with the South American colonies. The promise was intoxicating. Everyone from aristocrats to servants bought shares. The stock price climbed to extraordinary heights, divorced entirely from any rational assessment of profit. And when it fell, and it did fall, catastrophically, thousands lost their fortunes. The bubble became synonymous with foolishness, with the permanent folly of human greed. Yet within a decade, the financial markets of London had reconstituted themselves. They had learned something. The system adapted. 3 centuries later, in 1929, the world experienced something far more severe and consequential than the tulip craze or the South Sea bubble. The Great Crash of October 1929 and the Great Depression that followed represents perhaps the closest historical parallel to what unfolded in 2008. Markets collapsed, unemployment soared, suicides spiked, Families who believed themselves secure found themselves hollowed out. Bread lines stretched around city blocks. Children went hungry. The pain was real, immense, generational. But here is where the historical perspective begins to shift the weight of the story. Even the Depression, catastrophic as it was not permanent. Over the course of the 1930s, and accelerated by the demands of World War II, the economy eventually recovered. The institutions that survived were reformed. New regulations took root. The social security system emerged as a response to the terror of destitution. The Securities and Exchange Commission was established to police the very behaviors that had contributed to the crash. The system did not simply bounce back unthinking, it transformed itself. Looking at these patterns across centuries, from tulips to South Sea ships to the crash of 1929, what becomes visible is not the inevitability of collapse, but the remarkable resilience of human economic organization. Each panic, each crash, each moment when people believed the entire edifice must fall, was followed not by permanent darkness, but by adaptation, by learning, by a slow and gradual rebuilding that took years but eventually succeeded. This does not minimize what happened in 2008. The crisis was profound. The suffering was real and extensive. Homes were lost, retirements were decimated. Small businesses that had been nurtured across decades simply ceased to exist. Those were genuine tragedies, not abstractions in an economic textbook. And yet, when we position 2008 within this longer arc, something shifts in how we might perceive it. We live, most of us, in the aftermath of that crisis. The fact that we are here now, in a functioning global economy, with financial markets that continue to operate, with unemployment that has largely recovered, with institutions that have been reformed if not perfected. These are not small things. They are reminders that the fears of September 2008, as absolute and overwhelming as they felt in that moment, have proven not to be the end of the world, but rather a difficult passage through a known kind of storm. There is a rhythm to financial capitalism, a tide that goes out and comes back in. Sometimes it goes out very far and very quickly. The receding terrifies those who stand in it, who suddenly cannot believe the water will return. But the ocean's tides are governed by forces larger than any individual actor, and across human history, the tides of economy, for all their violence and unpredictability, have a deep regularity to them. What might this mean for how we think about the future? Perhaps simply this: the same forces that made 2008 feel like the end of the world, leverage, interconnectedness, human fear, the illusion of control, are not unique to that moment. They will emerge again in different forms, in different markets, with different technologies and instruments we have not yet invented. But they will emerge, and when they do, there will be new crises, new panics, new moments when people will fear that civilization itself hangs in balance. And yet, the historical record offers a whisper of reassurance across the centuries. Even the worst of these episodes, even the calamities that seemed absolutely catastrophic to those living through them, have given way to recovery, to learning, to slow and grinding adaptation. Human economies, it turns out, are far more resilient than they often appear in their darkest hours, not immune to suffering, not free from loss, but capable of continuation, of transformation, of finding new pathways forward, even after the old ones have become impassable. The panic of 2008 was real. The crisis was severe, and yet it has already begun to fade into the longer trajectory of financial history. One chapter among many, one storm among many others, each of which we have weathered and moved beyond. The years that followed the autumn of 2008 were years of slow, uneven breathing. Markets did not leap back to life with sudden vigor, as if they had merely been holding their breath. Instead, they woke as one does from a deep sleep, hesitant, sore, uncertain whether the ground beneath them would hold. Through 2009 and into 2010, the engines of commerce and credit began their patient restart, not with a roar, but with the careful turning of mechanisms long frozen in fear. Governments and central banks had opened their vaults and their pockets. The bailouts continued, the stimulus packages flowed, the interest rates were held near zero. The Federal Reserve kept the printing presses warm through long nights, creating trillions in new money, to flow into a system that had forgotten how to trust itself. It was a kind of medicine, bitter and unpleasant, but the patient, the entire global economy, needed it to remember how to live. Around the world, exchanges that had seen panic selling began to see hesitant buying again. The Nikkei in Tokyo, the FTSE in London, the DAX in Frankfurt. Slowly, incrementally, they climbed back toward levels that felt less like a descent into the abyss. The speed of this recovery varied, as it always does. Some nations healed faster than others. Some never quite returned to where they had been, or returned as something subtly different, reordered, reformed. The homes that had gone into foreclosure continued to be processed through the courts, a long, grinding aftermath that would stretch on for years, but the panic stopped. The sense that the entire edifice of global finance might collapse within weeks, that feeling loosened its grip. People began to sleep more soundly, though perhaps not without dreams of what they had lost. And yet something had changed, something deeper than any recovery in market indices could fully capture. Across the world, conversations had begun in hushed boardrooms and in the halls of government about what should never be allowed to happen again. The idea that the risks had been too hidden, the leverage too extreme, the oversight too thin, these thoughts took root and began to grow, slowly, into policy and into law. The Dodd-Frank Act came to America. European regulators tightened their frameworks. Central banks became more vigilant. It was imperfect, it was contested, but it was real. What is it, perhaps, that allows us to build again after such a fall? Is it merely the passage of time, or is it something deeper in human nature? The capacity to grieve, to learn, and then to choose differently. The financial system is, after all, built on belief, on faith, on the assumption that tomorrow will be stable enough that today's promises have meaning. When that faith breaks completely, the system stops. But faith can be rebuilt, more carefully, more thoughtfully, with more awareness of its fragility. By the middle of 2009, something subtle was shifting in the tone of financial journalists, central bankers, and traders. The word was not yet recovery, but it was becoming clear that the immediate danger had passed. The world was not going to end. Markets were not going to disappear into some dark abyss. The system, for all its flaws, had mechanisms within it that could stabilize it when it fell. That knowledge itself became a kind of tonic. Think for a moment about what dawn looked like on the trading floors in the autumn of 2009. The sun was rising over lower Manhattan just as it had a year before, when the crisis was still unfolding. The buildings were the same, the people were often the same, but they carried different knowledge now. They had seen the limits, they had felt the edge, and many of them, traders, analysts, executives, carried a quieter kind of caution, a memory of how fragile everything had seemed. In Tokyo, in London, in Singapore, in Hong Kong, the markets opened their sessions with a different cadence now. Not fearful, but more aware. The algorithms that would one day again seem to dominate the trading floor were being written by people who remembered 2008. For some, that memory would fade. For others, it would shape their entire careers. Around the world, families began to recover too, in their own time, at their own pace. The homes that were not lost were held a little more tightly, valued differently. The pensions that had recovered did so incrementally, and the people who depended on them could finally breathe more easily at night. The small business owners who had survived found their credit lines slowly unfreezing. It was not a return to what had been before, because you cannot return to the before. The shape of trust had been altered. What we might have learned, if we had fully paid attention, is something about cycles and resilience, about the relationship between fear and stability, about how much of our economic life rests not on law or mathematics, but on the willingness of millions of people to trust each other, to trust institutions, to believe that the system will hold. When that trust breaks, nothing works. When it returns, everything can work again, but the return is always slower than the breaking. As 2009 faded into 2010 and the years continued their march forward, the financial system was not quite the same as it had been, and perhaps we were not quite the same either. The memory of 2008 would linger in policy documents and in the back of traders' minds. It would influence decisions made in boardrooms about how much risk to take, how much leverage to accept, how much to trust in the smooth continuation of the present. Some of those lessons would stick, some would fade, as they always do. The dawn that followed 2008 did not feel like a dramatic sunrise, full of promise and clarity. It was more like a slow grey brightening, where the night finally admits that it is ending and the world can begin to see its own shape again. The street lights that had seemed so necessary in the deep dark began to feel less urgent. The emergency broadcasts that had become background noise fell silent. The vigil ended. And as we consider that world breathing again, learning to trust again, beginning to rebuild and reform, we might feel something settling in us as well. A quietness, a recognition that the great systems we depend on are larger than any one person, yet fragile enough to remind us of our interdependence. The lights of the world's financial centers came back on, not all at once, but one by one, until the night was no longer so absolute. The crisis, in time, became history. The fear transformed into memory, memory into caution, caution into better design. And the world learned, once again, what it has always known and always forgotten, that markets, like the night itself, are cycles. They go down, they come up, the darkness always ends. And in the patient work of rebuilding, there is something almost restful, something that feels like coming home to a familiar truth about how the world endures.